in together. And we're finishing up chapter 10. Going to do a little bit of review on that right now. And I have prepared for you a Kahoot. Did we do Kahoot yet? Good. Got another one. Go ahead and pull out your cell phones. Go to kahoot.it, kahoot.it. When it asks you for a game pin, there you go. There's the game pin. And this one will be pretty much about 10 that we've covered so far. I think you guys are doing pretty well with it. You can be anonymous if you want to. Doesn't matter what you name yourself. Winner gets $500 from your neighbor. Let us know how that goes. Beautiful. If you haven't yet, go ahead and put your name in the chat for me. Can you see it okay? The Kahoot screen? Good. That's about everybody who is with us at the moment. The others are going to be so jealous. Okay, here we go. All right. What does the Statute of Frauds say? Statute of Frauds. Can you guys see the answer choices on your phone? Okay, good. A document must be in writing to protect against third-party claims. A document must be in writing to be enforceable. A document must be recorded to be enforceable, or a document must be recorded to protect against third-party claims. And you're all cursing me right now. All right, so there's two things, Statute of Frauds and there's the Connor Act. But the Statute of Frauds is the one that says, you got it, good job. A document must be in writing to be enforceable. In writing. Things like what? What needs to be in writing? Tell me in the chat. What sorts of things should be in writing so that you can enforce them in a court of law? There's a big one, the contract, you bet. And pretty much anything that you want to enforce in a court of law needs to be in writing, right? So most things fall under the Statute of Frauds, but that's a good one that you mentioned, Joseph, because they do like to draw a distinction between the documents that have to be in writing and what is it that makes it so they have to be in writing, right? So yeah, you're right. The agency agreement does indeed have to be in writing, but it's not because of the Statute of Frauds. What is it that makes it so that an agency agreement has to be in writing? Is that a Statute of Frauds thing? No, it's a what? Who says that it must be in writing when it comes to agency agreements? I'll give you a hint. Yeah, the one who's making you take this class to get the license. It's a real estate commission rule that says agency agreements must be in writing. They like to test that. That's the only reason I'm calling you out on it. Because you might see that on the test. It's not a Statute of Frauds requirement that an agency agreement is in writing. It is a real estate rule. The red one, a document must be in writing to protect against third-party claims. I was mixing them up on you, right? The Connor Act says something has to be recorded to protect against third-party claims. And so I just swapped some words between the Connor Act and the Statute of Frauds. If you're just joining us, guys, you can look at the bottom of the screen, go to kahoot.it and plug in that game pin 9189474 918-9474. I'll put it in the chat for you. I'm not sure if you're joining us after we've started, if it'll let you play or not. I guess we're about to find out. But obviously you can play along at home. You just can't register an answer and we'll still get the same effect for you because we'll still be talking about it. So the red choice is nothing, right? It's a mix of the Connor Act and the statute of frauds. It's not its own thing. So that's not a good answer. The yellow choice, a document must be recorded to be enforceable. That is not a thing either. It's another mixture of the two. What about the green one? A document must be recorded to protect against third-party claims. That is a real thing, but it's not the statute of frauds. It's the Connor Act that means that one. So those are two that are easy to flip-flop and mix up. So just be watching out for that. At what point does the offer become a contract? When does that offer become a contract? When the seller's acceptance is communicated to the buyer by their agent, when the seller's acceptance is communicated to the listing agent, when the seller makes a counteroffer, or when the seller's acceptance is communicated to the buyer agent. I probably could have given you more time on this one, right? Probably would have helped to think, have a little more time to think. They're all 30 seconds, but yeah, we got a little bit of a split here. And let's think about the terms. This is all about terms and knowing who is who. So most of you said the red one, when the seller's acceptance is communicated to the buyer by their agent. What can we assume by reading this statement? The buyer has an agent, right? Hope that was clear. It might not have been as clear as I meant it to be. When the seller's acceptance is communicated to the buyer by the buyer's agent is what I meant by that. Forgive me if that's not how you read it. So I could clarify that better. But that's not the moment that it becomes a contract. That's not the communication that's required, is it? Telling the buyer by the buyer agent doesn't matter. I mean, it needs to happen, but once the buyer agent was informed is what matters. That's when the communication counts for it to be considered a contract. And that's what the green one is saying. When the seller's acceptance is communicated to the buyer agent, right? So let's spell it out a little bit. We've got an offer that has been made, written up by a buyer agent in this case. Here we go. Let's see. Got our buyer over here. Got our seller. Got our offer to purchase written up by that buyer agent because the answers kind of tell us, look, there is a buyer's agent. It's made and sent over to the listing agent. They told the seller told the listing agent that they accepted it, and then the listing agent told the buyer's agent. It's this one, right? That's what we're talking about in the green. The seller's acceptance, the fact that the seller accepted it, has been communicated to that buyer agent. And if I had more room to write it, because they only give me so many letters, I could have said by the listing agent. It's when the listing agent's communicating to the buyer agent, right? The red choice that some of you chose says that it's when the buyer agent tells the buyer, but that's not right. It's already been communicated to the point where that offer becomes a contract when the communication goes from listing agent to buyer's agent. Now, if instead of a buyer agent, the buyer's representative or the selling agent who's helping the buyer was this second option, sub-agent to seller, then the listing agent telling them would not be enough, and the red answer choice would be the better answer. And so don't forget, when we're going through this Kahoot and you're any practice exams, and and of course the actual exam, you're looking for the best answer, right? And they're only so big. So sometimes it might be kind of tough to decide between two. So it's real important in those moments that you not make assumptions and add more stuff to the mix than what they're actually talking about. So watch out for that. All right, got some switching up going on here. Which of the following may not be, oh boy, here we go. I'm taking up your time. There we go. Which of the following may not be included in a contract? A financing contingency, a brokerage relationship, time is of the essence for due diligence, or a limitation on the broker's liability? Which one is not allowed to be in a contract? Good job. Most of you got that one. There are, in fact, two things. I'm not going to talk about the other one yet because I can't remember if I made a question about it. But one of them is indeed a limitation of liability. Those brokers can't put something in the contract that says you're not going to sue me if I screw up. They're not allowed to have any liability protection for themselves built into that contract. So the green one is the best answer there. A financing contingency is allowed to be a part of a contract if you want it to be, if your client wants it to be. And one example of that would be, as we'll learn in the finance chapter, an FHA loan. An FHA loan carries with it some privileges for that borrower. The point of an FHA loan, Federal Housing Administration loan, is it's a government insured loan. It's helping somebody who doesn't have great credit, who doesn't have as much for down payment available. And so if you include an FHA loan addendum with your offer, if you write up that addendum and include it, meaning add it, not like create it from scratch, because they give it to us to use, then that is a financing contingency. Because what that addendum says is that if the appraisal doesn't come in at the full sale price, even after the due diligence period, the FHA buyer can walk away and get their money back. That's not the norm. It's only possible because of adding and including the FHA addendum to the standard. So whether it's that addendum or just anyone, you could have an attorney create a financing contingency. What is a financing contingency? Maybe we should start with that. It's something that just says, look, if the buyer's loan doesn't get approved, the buyer gets to walk away and get all their money back. The buyer's offer is contingent on getting approved for the loan, but that is not an automatic provision built into the standard contract. It's not even a form that we have access to. We would have to have an attorney write it, create it, or the parties could create it. The only one that is given to us to add if we want to is the FHA VA addendum, like I just mentioned earlier. So, which of the following may not be included in the contract? A financing contingency can certainly be included in a contract. That is certainly allowed. A brokerage relationship to the clients. Well, once you look through the contract, and I would suggest that is homework between now and next week, look up, and I'll attach it in the chat here too. Look through that contract, identify some of the things we've been talking about, like where the names of the parties are, and the financing language, and a couple more things that I'll let you know about. Hang on one second. I'm looking for this so I can go ahead and attach it while I'm thinking about it. What was the other one? Oh, so brokerage relationship to the client, that is actually mentioned. It's not the compensation, but it is mentioned in the contract where it says who represents who. There you go. All right. So that's in the chat for you. Let's take a look at that. Here we go. Here's our contract. It won't let me zoom. Maybe it's zoomed in pretty good. But if we go like to the second, I think it's the second to last page. Yeah, there's the last page. And then here's the second to last page. It's the part that says the notice information. This says, how do the parties, buyer and seller, as well as the agents for those buyers and sellers, want to be communicated with when it comes to submitting acceptance, notification of acceptance? When that offer is accepted, how do you want to be reached? And so this is a place where we say, how's the buyer being represented? By this firm as a buyer agent, as a seller sub-agent, or as a dual agent? Check the box. And then further down, the actual human agent themselves working for that firm, how are they? Are they going to be also a designated dual? And then the license numbers of those, the firm and the agent. And then for that selling agent helping the buyer, how do you want to be contacted? This is for the selling agent to say and decide. They may not want to be contacted by phone or by email. They might say, just talk to me through the phone. I don't want you to email me with notification of this offer being accepted. I put everything except for fax. I don't think anybody uses that. But that's what this is called. This page is for notification. At least one address and or electronic delivery address for each party who approves it for the receipt of any notice contemplated by this contract. Now, when it comes to my buyer client, or if I'm helping the seller, I don't give any of that info because I don't want them talking directly to my client. I put things like withheld, and I don't give them anything. Run it through me. You talk to me, and then I'll talk to the client, right? And so the same for the listing firm and the listing agent. So that's something you wouldn't have not had a reason to know. So that question sort of now you know. All right, let's pick it back up. Oh, got positions staying firm. Who does the buyer make out the check to earnest money? Who does the buyer make the check out for earnest money to? Do they make that out to the seller, to the attorney, to the firm or attorney holding the earnest money in trust, or to the broker that they hired? There you go. Yeah, whoever's holding that earnest money in trust. Good job. It is not the attorney, because it might be the attorney or it might be the broker they hired, but the best answer out of all of these is the one who is definitely holding that money in their trust account. So while blue and green could be the answer if it weren't for yellow, right? You need more information for either of those to be the answer. To make these the right answer, it would have to say the attorney holding the earnest money in their trust account, or the broker holding the earnest money in their trust account. So yellow is by far the best answer. What does the Connor Act say? A document must be in writing to protect against third-party claims. A document must be in writing to be enforceable. A document must be recorded to be enforceable, or must be recorded to protect against third-party claims. All right. Still confusing a little bit. It is the green one. Good job, most of you. A document must be recorded to protect against third-party claims. It's this idea. If you don't record the deed, then someone else could come along and say, well, I'm your third cousin once removed, and I own 10% of this property. And they would have the chance to make a claim against for ownership, some partial ownership of the property. But if you have it recorded with just your name and the seller's name that you bought it from, then you're protected from that sort of thing happening. So it's sort of that concept we're talking about. Again, the red and the yellow are just mashups of the two, the Connor Act and the Statute of Frauds. I just swapped them, and so they don't even make any sense. And nobody picked the blue one. So it's the the statute of frauds would have been the blue answer, must be in writing to be enforceable. And then the Connor Act, as this question says, is the green answer, must be recorded to protect against third-party claims. What's the most important document in a transaction? The deed, the contract, the offer to purchase, or the addendum? Good job. By far, most of you got that one. The contract is the most important document in a transaction. I have a follow-up question, and so I won't talk more about that until we get to that question. When does the seller get the proceeds check from the closing? When does the seller get the proceeds check from the closing? When the deed has been recorded, when the contract has been recorded, when the due diligence check clears the bank, or when the buyer gets the keys? Best answer. What's the best answer? That proceeds check doesn't get released until the deed has been recorded. Right? So we go to the settlement, sign the papers. We don't sit around and get any money yet. Everybody leaves. It's going to take a couple of hours. What's going on in those couple of hours? Well, after the settlement happens, everybody signs things. The paralegal for the attorney scans it all up and sends it to the lender. The lender looks it over to make sure we hit all the right spots in the initials and signature lines. And then the lender says, yep, looks good to us. And they fund the loan. They send the check over to the attorney. They wire the funds. They may have already done that, by the way. The funds might already be sitting in the attorney's account, but they're not allowed to release them until the lender gives the okay. Once the lender says, yep, looks good to us. And guess what? A lot of people like to close at the end of the month. That means that lender is not just sitting there waiting for your closing to happen. You're going to have to wait, because they've got a bunch of other closings that they're having to confirm that looks good too. Because everybody likes to close at the end of the month, and I'll explain that more when we get to chapter 21. It has to do with how much money the buyer is going to have to bring to closing. So they like to minimize that money by having fewer days remaining in the month of closing to pay interest per day for. We'll get more into that later. So, lender gives the okay. Attorney says, all right, great. And then the attorney checks one more time on the title search to make sure no other liens have been added to the property. They do one final check because there might have been some roofer or electrician that didn't file a mechanic's lien until just today or yesterday. Could have slid in there since the last time the attorney did a title search. So they check it one more time, and then if it all still looks clear, they go ahead and record the deed, either electronically or in person. And electronically and in person works the same way. You still have to wait in line in a queue. So just because you can do it electronically, like paying your phone bill, doesn't mean everybody can do it at the same time. You have to wait because an actual human is on the other end of that electronic connection on their machine, and they're making sure these things are all clear and good to go. And so 4 o'clock rolls around and nobody's recording anything anymore because that's when they close. So all of it has to be done by 4. So once it's recorded, now the paralegal tells the attorney, or maybe the paralegal might just skip the attorney because she knows what she's doing probably better than the attorney does. And she gives everybody notification. Look, we are on record. We have recorded. Hey, brokers, you can come get your check. Hey, seller, you can come get your check. And hey, buyer, you are free to get your keys. Now, sometimes the seller might decide to be laid back and cool about it, and they'll go ahead and let the buyer have the keys even before all of those things took place, even before the deed gets recorded. But as a broker, you just want to make sure they understand the potential for things going wrong. What if it doesn't record that day and you've given the buyer keys and the truck is halfway unloaded into your house and it's still your house because the recording didn't happen? It is our job to be the party pooper. It's our job to present the worst case scenario sometimes. But it could happen. They could still do it. Let's see. When did the seller get the proceeds from the closing? When the contract has been recorded, that's not right because the contract doesn't get recorded, right? That's not a thing that happens. The yellow one, when the due diligence check clears the bank, that's something that has already happened weeks ago. The due diligence check was given to the seller back on the effective date or right soon after that. And then it cleared the bank probably that week. So that has nothing to do with getting a proceeds check from the closing. And then when does the seller get the proceeds check? When the buyer gets the keys? Well, no, not that, because again, the seller could have already given the buyer the keys if they chose to. Good job, Alyssa. 5 in a row. Why is the contract the most important thing? I didn't realize I had this set to like scramble them. It should have been right after that other one. Is it because it's between the buyer and the seller and the brokers? Is it because a contract is non-negotiable? Is it most important because the terms of the contract inform what goes on the deed? Or is it the most important because a contract is time is of the essence? Well done. Because of the contract, the attorney knows what they need to write the deed up as. They know how to write the deed because they read the contract. That's the best answer. It's not read, and I threw an extra thing in there to kind of definitely make sure the contract and the red answer doesn't make any sense, because the contract is not between the brokers. Brokers are in the contract mentioned because they represent the parties, but it's not between a broker and either buyer or seller. It's between the buyers and sellers only. So that was sort of a decoy answer. The blue's not right because a contract is very negotiable. It's frequent that people renegotiate the contract even after it's signed around the inspections, around the repairs that are being asked. Because when that buyer decided to buy the house, they made that decision based on the assumption that the house was in pretty good shape, right? And then during the due diligence period, they're having inspections done, and then they find out just how bad of shape the house might actually be. And then they're reconsidering their options. They're thinking, wait, I may not want to buy this thing now that I know all the things that are wrong with it. And so can the buyer back out at that point because there's too much wrong with it and they don't even want to buy it anymore? Sure, long as they're willing to walk away from the due diligence money. But they might say, you know what, I don't like all these things that are wrong with it. It could be like some structural problems. It could be foundation, could be termites, could be the ghost of a sex offender that's haunting the house that they got killed in. I'm just kidding. That's all stigmatized property. But those, the buyer might say, well, okay, it's got a bunch wrong, but as long as the seller fixes it, sure, I'll still buy it, right? And then, okay, nobody answered your green one. Good. We'll leave that one alone. What is a provisional real estate broker prohibited from doing? What is a provisional real estate broker prohibited from doing? Showing homes to someone they do not represent. Working with more than one buyer at a time. Acting as a dual agent against her broker in charge. Or drafting language in a contract. Oh boy, I gotcha. And I'm glad this happened because I'd rather this happen now on a Kahoot than on the test. This is so easy to get confused. Guys, yellow is not the right answer, but I know what happened, and I totally get it. You saw provisional, you saw prohibited, and you saw dual agent and broker in charge, and it just clicked, and you're like, oh, I know this one. And you might have even skipped looking at a couple of their answers. But it's not a dual agent that a provisional is not allowed to be against the broker in charge. It's a designated dual agent that a provisional cannot be up against their broker in charge. We'll review that in just a moment. Let's get through these questions and we'll come back to this. Best answer here is draft language in a contract, right? Even if you were confused about the whole dual and provisional thing, we really impressed the point last week and last night that we cannot draft language. So that in and of itself should have been the best answer, recognizable as the best answer. But I get it. You probably were torn between the yellow and the green. Showing homes to somebody they do not represent, well, we can do that all the time, as long as we're willing to risk them not calling us back and them go. Because you could show a house to a buyer and you're the listing agent, and that's an unrepresented buyer. If they're unrepresented buyer, how else are they going to see it, right? Unless they might be working with an agent that's not their agent either, but that happens quite often. Somebody calls you on your yard sign and says, I want to see your listing. And you say, oh, do you have an agent? And they say, no, and I don't want one. Can I just see your house? And as long as your seller is willing to sell to them as an unrepresented buyer, sure, I'm going to show them that house. I'm just going to make sure they don't tell me anything confidential, that they understand they better not, because I'm a tattletale. I'm going to tell my seller whatever you tell me. So red certainly can happen. So back to that dual agent one. Dual agency. True dual agency. That's when a broker or multiple brokers in the firm are helping the buyer and the seller at the same time. They are both a buyer agent and a listing agent. You got that? You with me on that? Is a true dual agent a buyer agent? Yes. Are they a listing agent? Yes. At the same time, because they're dual. That's what dual agency is. It's being both of those things to both of those people, buyer and seller. And so it comes at a cost. The cost to true dual agency, the cost to the parties, buyer and seller, is loyalty is gone. You can't tell the seller things you know about the buyer, and you can't tell the buyer things you know about the seller. The confidentiality is still in place. You've got to keep everybody's business confidential. If the seller says, hey, wink, wink, I hired you 3 months ago. This clown just came along, called on the sign, this buyer, and you're going to be a dual agent, but you owe me a little more than them, right? How bad do you think they want it? Should I take their first offer or should I counter? You'd have to say, I can't help you with that. I can't be loyal to either one of you and give either one of you an advantage. This is called true dual agency. And so when you're a true dual agent, not a designated dual agent, but a true dual agent, then you and your other people in the firm are all true dual agents together, including your broker in charge. Whether you're provisional or non-provisional, all of you are true dual agents. Unless the parties don't like that and say, I don't like this, this is terrible. Do we have any other options besides me leaving this firm and going and getting my own buyer agent? At that point, you could say to them, yes, you could stay in the firm, and instead of doing true dual agency, we can get you a designated dual buyer agent for just you, still within our firm, and now we can restore loyalty, treat it like two separate firms again, and they're going to take care of you, and I'm going to take care of the seller. But up until that designated agency option has been exercised, everybody is a true dual agent. What does that mean? You are a provisional broker, and your broker in charge is responsible for you, and all those other brokers in your firm, all of you are true dual agents, which means neither of you can tell the buyer. If you know this information, you can't tell them the lowest the seller might be willing to take. And you can't tell the seller the most the buyer might be willing to pay. You can't give either one an advantage over the other. That's what true dual agency is, right? So yes, a provisional broker can act as a true dual agent, but it wouldn't be against the broker in charge. It'd be alongside the broker in charge, right? You'd both be prohibited from giving an advantage to either party over the other one. So what could we do to make yellow the right answer? Add the word designated, make it designated dual agency. That's what a provisional cannot be when they're up against their broker in charge. The PB is the listing agent. The broker in charge is the buyer agent. You can do that if you're both true dual, but you can't do it if you are designated for the seller and the broker in charge is designated for the buyer, or vice versa, right? So look out for that designated word. That's the one that's not allowed between a provisional and their BIC. What act allows for electronic signatures to be legal on contracts? The Truth in Lending Act, the Uniform Electronic Transmissions Act, the Marketable Title Act, or the Uniform Electronic Transactions Act? Good job. Uniform Electronic Transactions Act. I threw that other T word in there on you. You can hate me. I get it. But it's Transactions Act. That's the one. UETA. Green is the best choice there. There is no Transmissions Act. Which of the following may not be included in a contract? Now, this is that other thing. We already said liability limitation. What's the other thing of the two things? Brokerage compensation, brokerage relationship, time is of the essence, or earnest money being $0? Which one may not be included in a contract? Good job. Brokerage compensation, along with limitation of liability for the brokers, cannot be mentioned in the contract. And then time is of the essence for due diligence. Well, time is of the essence, in fact, is part of the due diligence provision for that period of time. It is time is of the essence. So that is in the contract. Does the buyer have to pay due diligence money in order to get due diligence time? Got to pay the money to get the time? Yes, no, depends, or not if they also pay earnest money. Does the buyer have to pay due diligence money in order to get due diligence time? No, they do not. No, they don't. Due diligence money is completely negotiable. It could be $0. Earnest money is completely negotiable. It could be $0. And due diligence period of time is completely negotiable. It could be $0. And the money is not attached to it. So you could have $0 due diligence money in the deal, but you still could expect 3 weeks of due diligence time in the period. Who does the buyer make the check for due diligence fee out to? Who do they make the due diligence check out to? The seller, the attorney, the firm or attorney holding the money in trust, or the broker they hired? We asked about earnest money a while ago. Now we're asking about the due diligence fee. Good job. They make that out directly to the seller. Those two checks are different. The earnest money check is getting made out to the firm or attorney that's holding it in trust, but we're talking about the due diligence money. That goes straight to the seller. That's made out to the seller, and it needs to be given to the seller by when? When do we got to give that due diligence money to the seller? By what date? Careful. Due diligence deadline is going to be maybe several weeks away. And it's not 3 days. It is, let's look at the contract. There we go. Scroll on up here to due diligence fee. first page of the contract. That due diligence fee made payable, delivered to the seller by when? The effective date. It's due by the effective date. There's no 3 days. There's no 5 days. This is the one where we were talking about how if it's nighttime and nobody wants to go back out and meet each other to give this check, most of the time it's cool with the seller and everyone else to just meet tomorrow. If we get this thing agreed and communicated and we're under contract tonight and you don't want to go out and handle it tonight, the brokers typically will say, let's connect tomorrow. I'll give you that due diligence check, or I'll drop it by the seller's house myself, says the buyer agent, right? That could happen. Leave it on the doorstep or knock on the door and give it to them. But if it's not able to be given to them on the effective date, which if we had a contract accepted and communicated tonight at 6/12 right now, then today is the effective date. That's what the effective date is, the date at which the final acceptance is communicated and everybody has signed and initialed and dated on the paperwork. So today's our effective date, and that money should be given to the seller by today. If the seller has a problem with that and doesn't like it, then they could say, look, I wanted it today. You didn't have it to me by midnight. So here's your notice, buyer. Giving you written notice. The seller has to put it in writing and send it over and say, I want my money within the next business day. And if I don't have it by then, I can get out of this deal. I'm out of this contract and I'm going to pursue you in court to get that earnest money and due diligence money. That could happen, but it doesn't usually, but it could. So the short answer here, due diligence fee is due when? By the effective date. Now, the earnest money is different. The earnest money we make out payable to the escrow agent, the one holding it in the trust account. And then when does it have to be collected? Well, that depends. It depends on which kind of earnest money it is. Is it initial or is it called additional? The only difference is when are you planning to give it away? When are you planning to give it to who's going to hold it in the trust account? Are you going to do it immediately within the first 5 days of effective date? Then we can call it initial earnest money. But if that's not what you want to do, and that's not what I do, as a buyer agent, I explain the situation to the buyer and I say, look, buyer, it will protect you more if we don't even do any initial earnest money. Forget that. We're going to give them earnest money and call it additional, because with that kind, we can claim whichever date we want it to be due. And we're going to make it due really close to the due diligence deadline day in 3 or 4 weeks. That way, if you decide to walk away, the seller can't refuse to release the earnest money to you. You follow me on that? If there is no earnest money in the trust account, the seller has no control to hold it hostage. They have no say-so over signing the release to release it, because there's nothing to release, because we agreed up front not to give it until day of due diligence deadline. Just a little nuance that still, and a lot of agents don't really, and I have to explain it a lot, but it shouldn't matter, and it usually doesn't matter to them because they're not thinking about that situation. But I feel like the buyer is best served by not putting it in the mix until further into the under contract period of time. Okay, got a couple more. There we go. Next question. Which of the following is not related to earnest money? Either not a name that you call it or not related to it. Good faith money, liquidated damages, consideration, or a show of the buyer's seriousness. Which of the following is not related to earnest money or not something you might call it? Good job. You do not call earnest money consideration. Consideration is what you're bringing to the closing table in exchange for the property, for the deed. 2 is, in fact, something you can call earnest money because it, along with the due diligence money, are the liquidated damages that are available to the seller in the case of the buyer breaching. the buyer breaches or backs out, the seller still keeps the earnest money depending on when they back out, right? But we would call earnest money liquidated damages. So that's not the right answer. Yellow's the best choice there. All right, here we go. Last one. What is it called when the deed has been recorded? Settlement, due diligence deadline, closing, or time is of the essence? Yeah, this is the closing. Closing has happened once the deed has been recorded. That may not be the same day as the settlement. We want it to be, but sometimes the settlement happens, which is when things are signed, but the closing doesn't happen until the deed gets recorded, and that might not be on the same day. So watch out for that. That is easily testable. Good job. Let's see who gets $500. Good job, Holly. All right. Which neighbor are you going to collect it from? We can't wait to hear. Okay. Let's pick up in chapter 10 where we left off. There we go. Okay. We had just talked about the due diligence process. What does the buyer need to investigate? And then, of course, it's whatever they want to. Obviously, inspections. And whatever the inspections reveal that they might also need to be inspected. That inspector might say, you also need to have a radon test done. You might need to check for mold, check for termites or wood-destroying insects. It's also, I think you guys had answered this last night, things like the survey. The buyer wants to have a survey done. Should the buyer have a survey done? And why? Tell me in the chat, should they have a survey done and why should they if the answer is yes? Why should that survey be done? It has to do with the title insurance. Remember that? The attorney's going to have a title search. There it is. It's about the encroachment possibility. Thank you, Holly. If the buyer doesn't have their own survey done when they buy the property, then their title insurance policy won't cover any problems that might arise due to an encroachment situation. So if it comes down later that the building in the back is over the property line, either from the neighbor's onto yours or yours onto the neighbor's, or the fence line or whatever, or driveway, house, the well, I've heard of that happening. The well wasn't dug on the actual property. It was actually on neighbor's land. Then your title policy won't cover it, but it would cover the dispute and the situation if you had a survey done, partly because if you had a survey done, that you would have discovered where those lines were and if there are any encroachments, right? It would keep it from even arising as a problem to begin with. So a survey should be done during that due diligence period to find out, do we have an issue there? Is everything within the bounds of the property as it should be? Could also be the insurance policy that your buyer's shopping for. So many times the buyer doesn't think about the insurance until after we're outside of the due diligence period. But they need to shop for that while they can still back out and minimize what they're losing. Just the due diligence, not the earnest. Because it might be for some reason that property has had repeated claims against it and therefore the insurance is going to be expensive. The policy might be so expensive that they don't want to buy the property because they can't afford the insurance, and that could affect their ability to qualify for the loan if the insurance policy is too much. Financing contingency. We've talked about that a little bit. And does the standard offer to purchase have one? Is there a financing contingency in the standard offer to purchase? Tell me yes or no in the chat. Is there an automatically built-in financing contingency in the contract? Let's take a look at it. There is talk of financing choices, but that is not a contingency. So here it is. Here's where we inform the seller in the contract what the buyer's intentions are. Are they going to do is it going to be cash? And if so, check this box. Buyer intends to pay cash. And are you going to include a verification that they actually have the cash? You should, right? And the seller's probably going to want to see what's called a proof of funds to make sure that cash is available. They really do have it. They have a note here in this blue box. If the buyer does not intend to get a new loan, seller is advised to get documentation from the buyer proving that the buyer can close on it without needing a loan or additional funds, that they have the money that they're saying that they do for paying cash. And then the loan talk here in this contract is this. Are you getting a first mortgage? Are you also going to get a second mortgage? Are you going to do anything else? Like maybe some government assistance type of a loan? And what is it? Is it going to be an FHA loan or VA, or is it a conventional, or is it a USDA? And what's the loan type? How much are you borrowing? So all of that is just FYI. Notice here in this blue box, it says the buyer's obligations under this contract are not conditional upon getting a loan. Basically, the buyer doesn't get qualified for the loan. They are just going to have to walk away and not buy it. And if they choose not to buy it, then they're going to lose the due diligence money and possibly the earnest money. One second, guys. Let's go ahead and take our break. We'll come back in 10. I'll see you back in 10. right, come on back together. Let's dig back in, finish up this chapter 10. All right, everybody, hear me? Hearing me okay? Okay, here we go. So there is no loan contingency in the contract automatically. You'd have to add it. If your client wanted it, they'd have to add it in there. What happens if that buyer's loan doesn't get approved while they're still within the due diligence period? What happens then? What can they do at that point? There you go. There you go. Yeah, if they're still within their due diligence period, they can walk away, hopefully get that earnest money back as long as the seller's cool and signs the release of earnest money. What if it's outside of the due diligence period that they decide to back out? That their loan doesn't get approved and therefore they decide to back out. Yeah, they lose some money, don't they? Lose more money. They're already going to lose the due diligence money. They're also going to lose that earnest money because they're outside of that due diligence period. So you just need to, as their broker, figure out how, as quickly as you can, what the likelihood is of them getting their loan approved, and at least getting to the point of a conditional loan approval. Right, while you're still able to conserve and get that earnest money back in case they decide to back out. Who would care? What entity would care about keys and possession being transferred prior to the actual closing? Like the situation where maybe the settlement happens on Friday and the closing is happening on Monday. And so somebody's staying in the house for those 2 days over the weekend, but they don't own it yet. What do we need to take care of? There you go. Yeah, I got to make sure that insurance coverage is in place. Make sure whoever's staying there has renter's insurance, and make sure that seller's coverage is still in place all the way through. All right, let's talk about offer and acceptance. We've touched on this a little bit. They like to test you on this with scenarios and paint like a scenario situation. So that offer becomes a contract when the offeree signs and therefore accepts the offer, and that acceptance is then communicated back to the offeror or their agent. Communication in acceptable manner is specified in the contract. What is the acceptable manner of communication? Well, that's when we looked at that page 15 and we see that it's whatever method the parties say is acceptable. So it's this one. There, right there. Notification to the buyer or the seller or to the listing agent or to the buyer agent. In what way? Phone number, email, fax. That's what they're talking about there. So whatever the contract spells out on that page about how notice is to be given. So we have offer and acceptance. We could have a couple of counteroffers in the mix. The original offer is rejected because it's countered with some other provisions. So the original offer is made, the seller makes a counter, which means a change, and they go back and forth, counteroffers back and forth. And then ultimately that last counteroffer is ends up being rejected. So that could certainly be the possibility. It could also be one of these. The last counteroffer is accepted, and now we have a successful a contract. What if an offeree wants to make changes to the terms of an offer prior to it being accepted? What would this create if an offeree makes changes? Yeah, that's true. Joseph says on the contract, if you just put all the information on that notification page, then any of that is fine. You're saying that you're good with any of that communication being used to relay this offer and acceptance notification. And in this, right, it doesn't have to just be one. It could be any or all. Any of them or all of them. So in this case, when someone makes a change to the terms of an offer prior to acceptance, that's a counter offer. And then you have to watch for how are those clients being represented? Are they represented by agents like a buyer agent, or is it a sub-agent to seller? All right. If it's a buyer agent helping that buyer, then telling them is good enough. Telling them is the same thing as telling the client, and now that offer has been that acceptance of the offer has been communicated, and that's good enough. But if that buyer is represented by not a buyer agent, but instead they are a sub-agent to seller, then telling the agent is not enough. That notification of the acceptance, that communication of the acceptance needs to be conveyed all the way to the actual customer. Since the agent that's helping them is not their buyer agent, now to them, they are the customer, not the client, right? It goes back to this little back and forth situation. Buyer and seller. And the one option would be that they're acting as a buyer agent. The other option would be a sub-agent to seller. If we're talking about this one, then it's not enough for this listing agent to give them the news. It's only officially considered under contract when they tell the buyer. And this person, either of these folks are called selling agents, right? Don't forget that part. A selling agent could be the buyer agent, or it could be the sub-agent to seller. If all you see them referred to as is a selling agent, you don't know enough information. All you know is they're helping the buyer in some way. What you don't yet know is it one or is it two? And that's important because you need to know who needs to be told in order for this to be officially under contract. Only communicated to make it under contract when the buyer knows if the agent helping them is a sub-agent to seller. Can't impress that upon you enough because they like to test you on that situation. So just watch out for that. All right, so we have some high-tech graphics here. ABC Realty is helping the buyer. XYZ Realty is helping the seller. And ABC Realty has an agent named John. John is an agent. It says the word agent. That therefore we know that John is the buyer's agent, right? It says the word client under buyer. That is also indication that John is a buyer's agent. If John was a sub-agent to the seller helping this buyer, then the buyer would be called a customer, not a client. Are you with me on that? Write that one down. Customer would mean that the buyer has representation by someone being a sub-agent to seller, right? Which isn't very much representation at all. They're helping him do stuff. They're helping him write the offer and navigate through this process, but they are not a buyer agent to that buyer. Then we have XYZ Realty helping the seller. Seller is the client, and there is no other option there. You have to be a listing agent for that seller, right? There is no oral listing agency allowed either. So Agent Mary is a listing agent for that seller, meaning the seller is her client. So here's our scenario. John, the buyer agent, delivers the offer on Monday at 6 p.m. The seller signs the offer in front of Mary. So Mary has it. She goes to the seller's house, and while she's in the house watching, the seller signs the offer at 8 p.m. Then Mary calls John at 9 p.m. and says, "We have a deal." And John calls the buyer at 10 p.m. and says, "We have a deal." And then the next day, on Tuesday morning, John delivers the contract to the buyer. John delivers the contract to the buyer on Tuesday morning. At what point in this timeline did this offer become a contract? Good job. Seen a lot of 9 p.m.s. Why is it 9 p.m.? Mary has called John. Let's see. The listing agent, Mary, has called the buyer agent, John. We crossed that line. Yeah, crossed that tennis net, that volleyball net. But why wasn't it 10? Why wasn't it when John told the actual buyer? Because John's a buyer agent. You got it. John's the buyer agent, and it's good enough. Telling John is the same thing as telling the buyer. So it's all about how that buyer's represented. In this case, John's a buyer agent, so the buyer to him is the client, not the customer. So it's 9 o'clock. You're right. What about this one? Let's do, this one. So in this case, John delivers the offer Monday at 6 p.m. The seller signs the offer in front of Mary at 8 p.m. Mary calls John at 9, says we have a deal. John calls the buyer at 10, says we have a deal. John delivers the contract to the buyer Tuesday morning. And what's going on up here? A lot of distracting motion. The buyer's the customer, though. The buyer's the customer being represented by sub-agent John. And the seller is the client to Agent Mary. And I've given you the answer already with the star, but that makes a difference between 9 o'clock and 10. In this case, John is a sub-agent, not a buyer agent. Therefore, it's not official until John has told the buyer and communicated to them that it has been accepted. So in that case, it's 10. There is something related to this process of notification, and it's called the mailbox rule. Mailbox rule, yes. In the chat, can you explain sub-agent again? That means that they didn't sign paperwork for the exclusive right to buy. You got it. How does an agent become a sub-agent to the seller? Basically, if the buyer won't sign exclusive buyer agency. That's essentially it. For some reason, they just don't get it. Maybe they were burned before and they're just not trusting. And so they refuse to sign. Can the agent still help them? Maybe. But if they are still able to help them, it's going to be as a sub-agent to seller, not as a buyer agent. What they need to check, though, what does that agent need to check on if they find out the buyer's not willing to hire them and sign the buyer agency agreement? What's an important step that broker needs to do? Yeah, find out if they can get paid or not. Find out if that commission is possible to get paid. Let's see. Share something with you again. any given listing agreement. This might mean more now that we're talking about it. This might be the same house we looked at before. Scrolling to the bottom, we see buyer agent on this house is getting paid 2.5%. But if that agent helping that buyer is not a buyer agent with an agreement in writing at time of offer, then the default is they become a sub-agent to seller. And in this case, they're not getting paid anything. So that's the big step they would make is, do I get paid if I'm not a buyer agent? And I bet we could probably scroll through just about every one of these and see nothing. I think last time, if you guys were the ones I did that with, I don't remember. Might have been something we did in 7 and 8. It was the same group. There might have been one that actually paid a sub-agency compensation. So you got to watch for that. That's a big deal. The mailbox rule says that the seller, for instance, could sign the offer and drop it in the mail. And when is it considered to have been delivered? When it hit the mailbox, when it got into the possession of the postal service. Now it's considered to have been delivered as of that date, even though it's going to be riding the truck for a while, a couple days, 2 or 3 days probably, right? It's considered delivered when mailed, not when it's actually received. So the delivery is what we're talking about there. The checks don't count. The mailbox rule doesn't apply to delivering checks. You can't say, well, I got you that due diligence check. It was in the mailbox today or 2 days ago. Yeah, but it didn't arrive into the possession of the seller until 3 days after that. So money doesn't work. The mailbox rule doesn't work for the money delivery, only for acceptance delivery. And it's considered having been delivered as soon as it's in the possession of the USPS, even though it doesn't hit the hands of the seller right away. I feel like the mailbox rule is almost irrelevant because we do so many things electronically now. Most things are done via electronic signing and email, but it's still a thing, so it's still possible. How can offers terminate? We touched on that in the last chapter. And you tell me. Mailbox rule is only for acceptance type conveyance. What sorts of things terminate offers as compared to contracts? Not contracts, we're talking about the offer. How can that be terminated? And it's okay if you just write what you see on the screen. Counter offer, of course, that kills it. That first offer is dead. The minute the other party makes a change, they've rejected it. They can revoke it. They can certainly revoke it. They can say, look, I don't want to do this anymore. Why might somebody revoke an offer? Because they find a better house and they're like, oh, this new one just came on the market. Remember that offer I made yesterday and I haven't heard back about yet? That seller was too slow. I'm hereby revoking it. Rescinding it is the better word. Rescinding that offer. Or if we put a deadline using the additional provisions addendum, there's a deadline you can put in. Say this offer is only good until noon tomorrow. Noon and 1 second tomorrow, this offer is dead. Because you put a self-destruct in there in the form of a deadline. So if that offeree fails to accept in the time stated in that offer, then it's off the table. Death of offeree terminates, but yes, exactly. Great point. In the chat, the death of an offeree, when we're talking about an offer, not a contract, terminates the offer. Either party dying kills an offer, buyer or seller. But when we're talking about a contract, not what we're seeing on this screen, but a contract, that does not kill a contract if the seller dies, because the contract would still be beholden upon the seller's heirs and estate. They still have to execute and honor it when it's a contract. If it's the buyer in a contract and the buyer dies, well, a dead person can't qualify for a loan, right? So the contract would die if it's a buyer who dies. Their heirs and estate would not have to honor the purchase if it's the buyer's side. It's only the seller dying in the case of a contract that the contract stays alive. And then this fourth bullet down here, acceptance is not communicated in a reasonable time frame. What in the world is reasonable? Well, who knows? It's kind of like it's going to depend on the authorities if it all turns into something and gets turned in. Reasonable time probably means several days, right? It's going to be like we gave them reasonable time to reply and they didn't. Therefore, we went on ahead and moved on to the next one. And then maybe you did that after like a week of giving them time to answer and they never did, and you didn't have a deadline in it. You just let it ride. A week later, that buyer has already moved on to another property and gotten an offer made and accepted, and they're under contract. And then they get notification that, oh, that seller from a week ago accepted your offer. They'd probably have a pretty good shot at not having to honor that first offer, because a week is probably beyond what's considered reasonable. But in that situation, I would kind of blame the agent a little bit, because the agent really should put a definitive close on that first offer. They should advise that buyer, look, buyer, if you're serious about a second house, let's go ahead and kill the offer on the first house. Let's not leave it up there in limbo unless you're willing to give up the due diligence money, right? That could be a way to handle it. As long as the buyer is willing and able to pay due diligence fee, then they can make offers to as many houses as they want to. Because then they could just back out from the ones that are not what they want to take and just stick with the one they want. So that's terminating offers. And by the way, guys, I need your cooperation. I've had a little bit of problem with people being on video or not being on video. It's kind of becoming a little bit redundant or, too popular. So a lot of people are either too dark in the terms of their lighting on their faces. I need nice, clear video, and I need active video during class time. I'm going to have to start enforcing a little bit more and putting people in waiting rooms more commonly if I don't get some cooperation here. It just messes it up. It's distracting for everybody, and I really need your help here. It's tough enough at nighttime, and I don't need the distraction, and your classmates don't either. I don't mean to be heavy, but sometimes you have to do that. So cooperate with me so we can all manage this properly and be respectful. All right, let's look at this example. On Monday, the sellers tell their agent that they have accepted and signed the buyer's offer. The listing agent tells the buyer's agent that they mailed the contract to the buyer's home address. The earnest money deposit was to be delivered within the 3 days of acceptance. On Tuesday, the sellers changed their mind about selling the house. The paperwork has not yet arrived at the buyer's home address, and the earnest money has not arrived to the seller's address. The listing agent emailed the buyer's agent to let him know that the seller changed their mind and instructed the buyer to destroy the signed offer to purchase when it does arrive. Which of the following is true? Number one, is it true that the sellers may unilaterally terminate because the contract is not valid until the money is received? Or is it that the seller may unilaterally terminate because each party has a 3-day right of rescission? Or is it that the sellers may not unilaterally terminate because they have to give the buyer until the end of the due diligence period? Or is it that the sellers may not unilaterally terminate because a binding sale contract exists? I'll give you time to kind of digest all of that. I kind of threw it at you sort of fast. Let me change this setting so it's private now. Get the rest of the answers that way. Get a couple more answers from those of you who have not answered yet. Most of you are on the right track there because you're right. It's number 4. What do we have here? Sellers told their agent they accepted and signed it. The listing agent told the buyer's agent they mailed it to the buyer's home address. The money's not delivered yet, but that doesn't matter. It's not about the money. They like to throw that in there to you, at you. So delivery of money does not affect whether this is an actual contract or not. Delivery of that money, not as important. On Tuesday, the seller changed their mind. Paperwork hasn't arrived to the buyer's home, and they try to say, look, tear it up when you get it. But that doesn't work. It's already been accepted. It's already officially under contract. So that seller cannot terminate because there is a binding contract. The money's not in their possession yet, but it needs to be. How are they going to get it if they want out? What happens now? The seller wants out. They basically say, I'm terminating. Well, sorry, you can't terminate. Well, I'm not going to sell it. If the seller responds that way, what is our next step? As a broker, the seller refuses to sell to that first buyer, to that buyer. What happens? Seller says, I'm not selling. You can't make me. We as the broker would say, well, no, I can't make you, but who might have something to say about that? Definitely. Yeah, somebody says refer to an attorney for sure. You bet. And essentially, yeah, take them to court. Who takes them to court? There it is. The buyer. Buyer can sue that seller for something. What's it called to sue a seller for breaching the contract? What's the name of that situation when you're suing a seller? There it is. Suing the seller for specific performance. Performing specifically to sell that property. That's what the buyer has and the power the buyer has. Just take them to court over it. Hey, is this an enforceable contract? Is it in writing? It hasn't arrived to the buyer yet, but it's en route. And they will have it, and they can take it to court and show it to the judge and say, this seller agreed to sell this to me. The judge is going to say, let me see it in writing, and here it is in writing. So yeah, it's enforceable. It's in writing. So as long as that seller is willing to be sued for specific performance, they better sell it and go through with it. The other thing the buyer can do is what? In addition to suing the seller for specific performance, the buyer could also do what? the buyer can sue them for all the money that they've spent on inspections. At this point in this early stage, they probably haven't spent much money, but they could seek to get back their due diligence money, their earnest money, whatever they've spent on inspections and appraisal, depending on how far along it goes. As to the firm suing, well, what could the firm go after the seller for? Not to enforce the contract, but the firm would have potentially a case, maybe for the commission. But what is it that deems the commission to have been earned? How do we know the commission has been considered earned? There it is. Procuring a ready, willing, and able buyer. You got it. I'm going to open the chat back up for everybody. Procuring a ready, willing, and able buyer. So at this early stage, if that buyer needs to get financing, then you probably, as a firm, don't have what you need to win that case. You can prove ready and willing because they came and made an offer and it was accepted, but they haven't proven to be able yet. If it were a cash deal, then yeah, they're able also. But if they're getting financing, that loan approval would be what would need to happen in order to be considered ready, willing, and able. So you may not have much of a case as a firm, but the buyer sure would have a case against the seller to sue them for specific performance. Let's look at some addenda, some of those various addenda. These are by far not all of them, but these are very commonly used ones. And we're going to go through each of them just to kind of touch on them. I could show them to you in real life, but let's just look at the provisions of them. The one of them is the additional provisions addendum, and that accomplishes several things. Let me show you that one, actually. We touched on it the other night. There it is. Additional provisions. The number one thing, the very first item, is the expiration. If your buyer says, well, I don't want this seller just having forever to think about my offer, to never respond, and we need to put an expiration in there. And so it would be a time and a date by which this offer is going to expire. Time is of the essence. So that number one is a possibility. Number two would be if there's a septic system and it needs to perk for something. That septic system needs to perk for a certain number of bedroom house. So if that applies, if you need that when you make your offer, your buyer wants to make sure that they can put the size house they want to on there for the size septic system that it requires, then that's what you'll use. Any of these six. And obviously it could be any one of these items. It could be a couple of them. If it's an investment property, it's going to be this one. Acknowledging that it is an investment property and the seller is to deliver the documents associated with the lease, including statements of deposits and all that fun stuff. And then number 4 looks kind of funny. It's a bunch of blank spaces. And you might be thinking, well, what about this whole thing where we can't draft language? Looks like you're going to have to draft some language to fill up those spaces, right? This is meant to be something that doesn't fall under the category of repairs, right? Seller agrees prior to settlement and at their expense to complete the following items. It could be something like the carpet is old. We need a carpet allowance, or we want you to replace the carpet. It's a lot of times it's cosmetic related things. Those can't really expect those to fall in with the repairs, the inspection process. But we might want to make that offer. The buyer might want to make that offer to cover it. Make the offer so that these repair items or these cosmetic items are Yeah, I'll pay you this amount of money, but only if it's got new carpet, only if it's got new paint, only if you take down that terrible wallpaper. So it could be that sort of thing, or anything that's going to make that they want to make the offer contingent upon, that has to do with largely cosmetic kinds of things usually. So notice down here it also says the buyer has the right to verify that these items have been completed in a good and workmanlike manner. So it could be some repair things. It could be redundancy too. Even though we might know it's something that needs to be repaired, maybe like the water heater's clearly not present or not working or blown up or something clearly is broken. We might want to, even though that's going to show up on the inspection report, just make sure that they know, look, this offer is contingent upon you indeed replacing the water heater. It's okay to be redundant, right? It's okay to put stuff in there that gets covered, make sure everybody's on the same page. And so that's where we could apply such a thing. If the property has a mobile home on it, if there's a mobile home on the property, here's where we're going to identify it and put in the VIN numbers. The vehicle identification numbers are on a mobile home, and this is a place to record those. So we might just use this additional provisions addendum to accomplish that one goal. And then finally, the most recent one they added a couple years ago was when you have a pool or a spa, you can't really inspect it unless you de-winterize it. So right now, most people's pools are closed. You would need to get it working again so that the inspector could verify that it works. And so re-winterizing it after the inspection happens is going to be on who's going to pay for that. It's negotiable. So check the box to determine who's going to be responsible for that sort of thing. So this particular one is the additional provisions addendum. You do need to be familiar with what these few addenda cover. And most of the addenda that they're mentioning in the slide here are the ones that show up in the contract automatically. They have like a pick list of the top ones that everybody tends to have to deal with. There's always this provision here if you need to add a custom made one that an attorney drafted or a party to the transaction drafted. But we're going to be talking about these ones that are pretty much included in the standard offer to purchase to be possibly used. So what else? That additional provisions, again, has a deadline. Talks about tenants if there's tenants in place. Talks about the septic system. Any improvements, that the buyer might want. And manufactured housing or pools. That's what we're dealing with additional provisions addendum. What about the financing addendum for FHA or VA loans? We've touched on this a little bit. We'll get more into that on the next chapter. But what is an FHA loan? It's a loan that the government is involved with. The government is insuring an FHA loan. They're insuring it so that if the borrower defaults and doesn't pay the mortgage payment, the lender is not harmed quite so much because the FHA has insured it to a point where it's not as much of a loss to the lender. And so an FHA loan stands for Federal Housing Administration. It could also be a Veterans Affairs loan for military vets. If you're a military vet or spouse of a military vet or currently active military, you could have a loan that lets you put no money down. Common provision, a common advantage of a VA loan is no down payment. You can borrow the full sale price. Because it's a government loan, they tend to take a little longer. I've got a lender that he kind of brags that he can do them faster than that. But just to be safe, if I were writing up an offer, my buyer wanted to use a VA loan, I'd probably, unless I had a really strong guarantee, I would probably want to have at least 45 to 60 days for the closing, just to make sure all of those various government interactions could have time to be covered. You bet. Great point Joseph makes, that you could certainly list your house and say, I'm only making this available for cash buyers. because I don't want to hassle with any of the loan process. That's not any sort of discrimination that's illegal. You could say no of any of those things. Let me show you something there. And that's something you'll see. There it is in the listing agreement. That is also in the Google Drive. Here's our listing agreement. And so we can go down through here. Let's see where I can find it. There it is. Seller lists the property at a price of such and such on the following terms. Check the box if it's cash only. Or, yeah, I'll do cash, or I'll also consider a buyer using FHA and VA. Or maybe frequently it's cash, FHA, VA, and conventional. USDA is a type of loan that applies only to rural areas. It allows the buyer to put zero down payment, borrow the whole amount, and it's also only for buyers who have a very limited household income. It's for low income to moderate income buyers, for rural properties only, not in the city limits. You can look up the map that allows for USDA financing. We'll get more into that in the next chapter. And it's usually the fringe outer areas of a county, the rural parts that are still country. Between that and the income limits, properties may not apply to this USDA financing. Loan assumptions, seller financing, I rarely use those because I rarely do them, but it's usually cash, FHA, VA, or conventional that a seller is willing to do. Now, what could happen is originally the seller was willing to sell to an FHA buyer, but what happens when a buyer is using FHA money to borrow for their loan is that there's a special kind of appraiser who's certified to appraise homes for FHA loan types. Think about this. If you're getting an FHA loan or a VA loan, it's because those loans were created to help people who otherwise wouldn't be able to get a conventional loan, right? A conventional loan, as we'll learn when we get to the next chapter, requires a little more down payment, requires a little higher credit score. So an FHA or a VA loan are a way for people to buy a home with lower credit score and also lower down payment. So we want to help them. We don't want to set them up to fail. They already are trying to get in for lower money. So clearly money is more of an issue. And so an FHA appraiser is not going to pass the house if it needs a roof next year. If that roof is in bad shape, you're not buying this house with an FHA loan. That FHA appraiser is going to say, nope, needs a new roof before we'll authorize this FHA financing. Well, who's going to put the roof on? Probably not the seller in this market. Seller might say, well, you're telling me I have to put on a roof for $12,000? No, I think I'll just say no to that. Keep the due diligence money and let that FHA buyer walk away. And I'll just put it back on the market and find a buyer who's not going to ask me to put on a roof. But here's the thing about an FHA appraisal. That appraisal comes in, talks about the roof, and maybe it appraises low. What if that FHA appraisal comes in $20,000 lower than the sale price? If it's an FHA appraisal, it sticks to the property for 4 months. It attaches to the property for 4 months. What does that mean? If the seller says no to the buyer, hey buyer, I'm not selling to you because I'm not going to come down to the appraised value, you can just walk away for all I care. And the buyer does walk. If the seller puts it back on the market and another FHA buyer comes along, they're going to have to use that same appraisal for 4 months' time. If it's within the 4 month time, same appraisal must be used. So, getting around to the point here, in that situation, why would we put it back on the market and try to find another FHA buyer? We'd probably change this and say, okay, we'll take cash buyers, conventional buyers only, no FHA or VA, because we don't want to fix the roof. A conventional buyer won't ask me to fix the roof. Cash buyer won't either. But it won't pass an FHA appraisal, and the FHA appraisal came in low, so we don't want that to be sticking to the house. So that'd be a case where they change who they're willing. Why would a seller take what risk? Give me a little more elaboration there. Oh, yeah. Well, it would open them up to more potential buyers, and certain price points might result in bringing more buyers than others. Like maybe a little bit lower price point, you might just all the buyers that are interested in your house might need FHA financing. So it would open you up to more of a buyer pool potentially. If you're willing as a seller to only be available to conventional and cash buyers, may not matter, but it could. So it might just slow you down to find that right buyer who doesn't need FHA financing. But otherwise, you're right. Why bother? Why take the risk? Okay, what else? That FHA VA financing addendum, if we attach it to the offer, what does it do? It allows the borrower to terminate the offer to purchase after the end of the due diligence period without losing their earnest money. They still would get the earnest money back even though they're backing out after the due diligence period deadline if the property doesn't appraise for the purchase price. So it says in there that it must appraise for the purchase price, and if it doesn't, the borrower gets to back out. Let me see if I've got one handy here. There we go. So it's just a little, I think, 2-pager, yeah. And the bulk of it, it's either one or the other, FHA or VA. And it's a bunch of legalese. It's kind of hard to understand, hard to read it. But it basically says here, it must appraise for not less than this amount. We're going to put the purchase price in that blank. If the purchaser, they have the privilege and option of proceeding, even though it doesn't appraise if they want to. But the purchaser is not obligated to complete the purchase or incur a penalty for forfeiture of earnest money if it doesn't appraise for this amount, even after the due diligence period is over. So they get to walk and get their earnest money back after due diligence period if they're backing out because it wouldn't appraise for full value. And essentially the same thing applies to the VA. That's about it as far as those go. What else? It also doesn't work unless you include it. Just because your borrower's getting FHA loan doesn't mean they have this protection. They only have this protection if you, the broker, gets this addendum and puts it in along with the offer and contract. Make it a part of the contract in order to get the protection for your borrower, for your buyer. If you don't have this addendum, there is no financing contingency built in. There's another one. What do you think a backup contract addendum is talking about? Backup contract addendum. What are we doing with that? What is a backup contract? Why would a buyer want to be in a backup position? In a market like this, a lot of buyers are losing. Yeah. They might have come along, they might have found it pretty fast, but not fast enough. And so someone beat them to it, but they still really like it. And one thing they might ask their buyer agent is, hey, could you check and see if that seller would take a backup offer? And if they will, then we're going to use it and solidify that with a special addendum called the backup contract addendum. Why? Why put it in writing? Because by having this in place, then that borrower, backup buyer contract is automatically going to rise to the primary position if the first one goes away. Either because their loan doesn't get approved or because they just choose not to buy it, or maybe something that was revealed in the inspection is just more than they want to take on. The seller's not willing to fix it. So it lets them be next in line without having to worry that the seller's going to put it back on the market to sell to someone else. Moving them from that second position up to the first position would be something given to them in writing. And them moving to that first position is final. They're definitely the first position buyer if the current one goes away. That backup buyer rises to that first position. What if the backup buyer says, hey, agent, let's keep looking. I don't want to sit there and risk that house actually closing and being bought by that other guy. Let's go ahead and keep watching. I don't want to waste time. And you show them 5 more houses, and the third one you show them, they just love it more than the one that they have a backup offer with, backup contract with. What do you do as their broker when they tell you, I like this one way more than I do the one that I have a backup contract on? What's your best move now as their broker? They have a backup offer on house 1. They find another house in the meantime because they want you to keep showing them stuff, and they like that better. Well, yeah. Basically, if they want to preserve their due diligence money on that first offer, which they haven't had to give yet, by the way, but if it were to get accepted or they would rise to that primary position before they had worked something out on the second one, then they would have to pay them the due diligence money also. So yeah, they could still back out from that first one, but at the expense of their due diligence money. So the only way to save that from happening is, like you're telling me in the chat, rescind it. As long as they withdraw it before they get the notification that it's been moved to the primary position, they have the freedom to do that, and they don't stand to lose any money. So you're going to have to, what if they say, well, gosh, what if this second one doesn't accept it and we can't work it out on the second one? I don't want to lose my spot on the first one. Well, you're just going to have to pick something, buyer. It's your problem. You wouldn't say that, but you'd be like, okay, depends on your level of risk. Do you want to go ahead and hurry up and see if we can get this second one worked out first? And just not tell the other backup offer people what you're doing so that you don't lose your spot in line just in case? Okay, fine. But the worst case scenario then is that it rises to that primary position and they also get accepted on the second one that they're trying, and now they owe due diligence money for both, right? So that's their risk. They're not going to be forced to buy 2 houses. They're just going to have to maybe pay 2 due diligence monies on one house that they're not going to buy. There's another thing that's not a thing anymore. This is gone. They've done away with the contingent sale addendum, but the way we handle this situation could still happen, and your client could still choose to incorporate one. We just don't have a standard form for it. So let me tell you what it means. What is this contingent sale addendum? We mentioned it yesterday. If the buyer has a house that they currently own and they want to sell it in order to buy this next house you're helping them buy, they don't want to commit to buying that next house until they know their current house gets sold, right? Because they can't afford 2. So a contingent sale addendum says to the seller of the one they want to buy, look, guys, I'm not going to buy your house if I can't get mine sold. Me buying your house is contingent on me selling my current one. But we stopped using it. A lot of brokers just didn't like to use this addendum because it was a little confusing, had some weird dates and stuff. And so instead of even using it, we would just have more due diligence time built in. We'd say, well, instead of a 2 or 3 week due diligence period, let's make it like a 6 or 8 week due diligence period. And during that period, the buyer can hurry up and try to get their house at least under contract and feel really strongly that it's going to definitely close. And then they can still back out of the one they're trying to buy just in case it doesn't go to plan, just in case they can't actually get their current one sold. So because we didn't use it that much, they just kind of took it away from us as a standard form that we have to pick from. Not to say it's illegal, right? Your buyer could still do it, but they're going to have to get an attorney to draw it up for them. So it's still possible to see it out there in the wild. What they also did is kind of modified the contract to mention it. And even though there is no due diligence agreement, let me show you something. They basically took the guts out of it and inserted those into the standard offer to purchase as sort of a notification, sort of like what the loan is. The loan is a notification, not a contingency. So here we are. The buyer does or does not have to sell or lease other property to qualify for a new loan or to complete this purchase. Again, this is not a contingency in and of itself. It's just an FYI to the seller. Hey, seller, I do want to sell my property in order to buy yours. But if I can't sell my property, I'm not necessarily going to back out. I'm just going to, if I do back out, still lose the due diligence money. It just gives a way to tell the seller what's going on. The first box says, is the buyer's current property under contract as of the date of this offer on the next house they want to buy? That's the better choice. At least then the seller would feel better that that buyer doesn't need to find a buyer for their house. It's at least under contract and it's looking pretty strong. Or if not, the other property's not under contract, but what? It's either listed with a broker or listed, will be listed, not yet listed, but it's going to be, or they're attempting to sell it by themselves. That's probably the weakest notification you could give this seller. Seller's probably not going to like that the buyer's trying to sell their own property because it's probably going to be possibly overpriced. It might not sell so fast. They don't have the guidance of a broker. So the strongest way to convince a seller to take your offer if you need to sell your house in order to buy their house is to have it under contract. And if you don't, at least have it currently listed, right? So you're thinking, how can I make this seller not choose against me because I haven't sold my house yet? That's what I'm talking about. What would be the game plan? That's what you as a broker are going to talk through with your client. But this does not say that if the buyer's house doesn't close, that they don't have to buy this house and they're going to get all their money back. They'll still lose their due diligence money and maybe their earnest money, depending on when they back out, if it were not to sell. Let's see, can there be a contingency that they can't sell till they find a new house like the other direction? Basically, the seller having some sort of a contingency that we need to have a place to go because we don't want to be homeless. Of course, the parties could make any provision they want to. I don't see it out there that much. What I like to tell sellers who have that concern, because that is a very valid concern that I hear quite often. Sellers just worried they'll be homeless, have to sell. But I tell them, look, guys, no matter how good the offer on your house might be, you still don't have to take it. Because it's not just about the price. Even if it's asking price, even if it's $50,000 over asking, you can still turn it down. You are still in control, Mr. Seller. It might hurt our feelings because we did what we were supposed to do. We gave you a great offer, but it's not going to force you to be homeless. You could still turn it down. So what I like to do is say, here's our game plan, seller. If you're worried about this, we'll put it on the market. We'll try to get offers. If we get offers and you need a place to go, we will do a search. In that moment, you will have already been informed. I will have already educated you on what's out there and available. Not that you could have bought it yet, but here's what's out there. But in that moment of getting the offer, let's take another look, see if there's anything that's intriguing to you. If there is, we might even try to hold those offers at bay and not respond to them right away and see if we can get an offer made on the next one. So we would kind of balance it, try to time it. But another point there, good point, you could always have them rent. They could just commit to renting and go ahead and get it sold, and that'd be a pretty strong position. That seller could go ahead and rent and then have the proceeds from their sale and then, just time it better that way. But you could work out both. Yeah. And it's always smart to try to make sure they know I can help you sell it, but I can also help you buy the next one. You want to be the one. You don't want to be two different agents trying to coordinate. Sometimes they have family friends that are agents and they try to spread the wealth and use you for the listing and another one for the buy, but it usually works better to use the one agent for both because you're motivated, you're incentivized, and you might even be able to and be willing to give them more of a deal. and list it for less because you know you're going to get paid helping them buy the next one. Quite often that next one they're buying is more than the one they're selling. So it's all a business decision at that point. But what is a business decision now is our 10-minute break. So I'll see you back in a few minutes. Welcome back. Halfway through the night. Hanging in there, guys. Okay, so that's the contingent sale addendum, but again, we don't have a standard form for it. If they want to use one, they'd have to get one made. What else? We've touched on this disclosure a little bit, but they call it an addendum. They call it a lead-based paint hazard addendum. And when do we use it? When do we use such a thing? In which cases, for what houses, would we use a lead-based paint hazard addendum? It's all about that 1978. You got it. Houses built before 78 might have lead-based paint in them. Might. And that's all this thing is talking about. This addendum says this. Here's what lead-based paint is about. It's hazardous, especially to young children. They could develop lead poisoning if they chew on the paint, like the window sills. Or if you move and open the windows and it releases dust, lead-based paint dust gets breathed in. Could cause permanent neurological damage, learning disabilities, impaired memory. It also is risky to pregnant women. Very young, very old, as well as pregnant women. And so the seller is required to disclose only that it might be there. It's a very important difference. Write that one down. Does the seller have to test for lead-based paint? No. They just have to say, look, guys, my house was built before 78, so lead-based paint might be under there somewhere. Might be under all those layers somewhere. And so this disclosure is all about that seller disclosing whatever it is that they do know. If they know for sure that the house has lead-based paint in it, they'll say so. They can't check no representation. They have to say yes or no. Yes or I don't know, right? Or yes or no, or I don't know. So what situation might arise that could cause that seller to have tested for lead-based paint? People don't usually test for it unless they have a good reason. And the reason they would be if they had work done on it before they sold it, maybe like a year or two earlier, or even just right before or during. If they have to like tear down sheetrock or things that have the paint, new windows or rotted walls under the windows. I've seen that happen. Anytime where a contractor needs to do repair work, that contractor is going to ask, is this house built before 78? And then if it is, before they can do the work, they have to take a sample and send it off and verify whether it's lead-based or not. If you hire a contractor to do work on your house, they have to do that. That if you do the work on your house yourself, you are exempt from having to test for it. Just don't breathe it in, right? So if for some reason like that, you do happen to know that there's lead-based paint, a seller would disclose it. They do know of a hazard. They did test, and yes, it does have it. If that's the case, attach the report if you got it. But usually the seller doesn't know because they've never had to test it and they're not required to. So they're going to check that second choice. I have no knowledge of it. I just know it could be there because of the age of the home. And I have no records or reports about it. So that's all the seller is checking. What the seller is also, that's it. That's what the seller's doing. And then the buyer comes along, wants to make an offer. The listing agent provides this disclosure so that they can see what the seller had to say about lead-based paint. And the buyer is initialing here to acknowledge that they saw what the seller said. They are also initialing to check to verify that their agent gave them a special pamphlet called Protect Your Family from Lead in the Home. That's a free through the EPA, Environmental Protection Agency. You could look it up. You could Google it and get the PDF for that pamphlet. And then the buyer, after having acknowledged that they received this information, even if it's no information, acknowledges what they're going to do. Are they going to do their own assessment? And if so, check the first box. You'll do it during the due diligence period. Have that lead-based paint tested Or more frequently that I've seen, they just waive it. They say, you know what? I'm going to paint it anyway because it's a terrible color. I didn't like the color you picked. It would be an extra layer of paint because remember, with lead-based paint, the choices are to remove it or to encapsulate it. Those are the two ways to remediate the situation. So just paint over it some more. One thing that lead-based paint could also lead to when it comes to back to that FHA type of a buyer is if the paint on the outside of the house is peeling down to the bare wood. And I've seen that a couple of times. If it's peeling down to the bare wood, well, guess what? If it's built before 78, there's some lead-based paint getting out, if indeed it has it, because it's going all the way back to the original paint coats. And the problem is, if it's outdoor paint and it's peeling and chipping off of the house down to the wood and getting into the soil, now it's contaminating the soil, maybe the water supply, and blah, 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 blah. So an FHA appraiser is going to say, oh, I'm seeing paint chipping down to the wood, not going to give FHA loan money on a property that has peeling paint built before 78. And so sometimes people have little painting parties so that they can make sure that FHA loan gets approved. And it might be the agents, it might be the seller, and they all get out there together and paint this house so they don't have bare wood showing because they're not going to get the FHA loan for that buyer otherwise. People do interesting things to hold a deal together. Okay, back to this disclosure. Finally, this is the one disclosure where an agent actually also signs it. So here are the agent initials saying, yep, I was told the seller what I'm supposed to tell them, what their obligations are. All their obligations are is to tell whatever they know and just state that they could have lead-based paint since it was built before 78. And that's about it. And then a place for the buyer and seller to sign, but also a place for both agents to sign at the bottom. But no other disclosure has a place for agents to sign. So this is a disclosure, but it's also called an addendum because if the house is built before 78, this has to be attached to it, to the contract as an addendum. There we go. Okay, let's review. This addendum must be used if the property is built before 78. The seller has to provide the addendum and indicate whether they know for sure if there's lead-based paint, or tell them whatever they do know. If they know or if they don't know, just let them know. And then also include the pamphlet. And you, as their broker, are going to be the resource for these things. You'll provide the seller with the disclosure and the pamphlet so that they can in turn provide it to those various buyers making offers. And then on this disclosure, the buyer signifies what they're going to do about it, if anything. Yeah, I'm going to do my own assessment, or no, I'm not going to bother. I'm waiving my right to do a risk assessment, have it tested for lead-based paint. So just need to know those little bits about those various addenda. Those addenda may not even apply. None of them might apply to any particular sale. But those are some of the more popular ones. All right, some procedures. If offerors and offerees want to add a condition to an offer that is not already in the standard offer to purchase, what sort of document would they use to add provisions to offers? I set it to private, so I'm seeing some answers coming in here, and so far you are correct. Let me get a couple more. They're just coming on in. You bet. Amendment or addendum? The answer is an addendum. An addendum is what you use with an offer. That's the big difference. For changing or adding to an offer, it's going to be an addendum. Once it becomes a contract and we need to change it, that's going to be an amendment. What are some acceptable ways to communicate that the offer has been accepted? It's in the pictures. Could be in person on the far right. Could be text or email. Could be phone, right? In person, text, email, phone. or ways you can communicate acceptance. How about all of them? How about let's just make sure that other agent finds out, because some agents are not great about answering the phone. Some agents don't even look at their email. Text is the best way for some. In person, everybody's sort of up in the air about that. They don't have time to drive across town and meet somebody. But if I'm giving notification of acceptance, I'm going to email them, I'm going to text them, and I'm going to call them. I'm going to try all of them. Just to make sure they find out for sure, one way or another. When you get an offer on a house, when do you have to present that offer to your client? At what point do you have to present an offer to your client? There's two possible answers depending on what the answer choices are, but definitely immediately, if possible, but not later than how many days is also okay. There's a lot of 3-day time periods in this business, and this is one of them. This is another one of them. So it depends on what the answer choices that they give you on the test are. If the answer choices are, when does the agent have to present offers? And the answer choices are 3, 5, 7, or 9 days, then obviously the best choice out of those is 3. If it says, when is it immediately, or 3, 5, or 7? Well, now we've got both, immediately and 3, but the best answer would be immediately. You want to get that offer into the hands of your buyer or in the email ASAP. I think the reason for the 3 days is really for mail. Back when we mailed things more frequently, because riding the mail truck took about 3 days typically. So it's almost irrelevant now. We can do everything immediately or within minutes instead of days now. So we as brokers are obligated by real estate license law. How do we know that? Well, it says it, but it's also referencing the license law, and they're talking about a 93A something. Anything that has a 93 on it means it's a license law. If it has a 58, it means it's a commission rule. Just a reminder. But it's a law. It's real estate law that we must disclose any offers, all offers to the seller immediately, but not later than 3 days from the date of the offer. And the other thing is, the listing agent cannot accept or reject an offer on behalf of the seller or screen them. What does that mean? Well, it may not be a surprise to you that some agents do this business incorrectly. They might even be embarrassed to present an offer to their client because maybe the client is sort of one of those volatile kind of people. Do you ever have a person in your life that anytime they get news, I saw eyes rolling, that was great. Anytime they get news, you just know, oh boy, here comes the earthquake. You hate to be in the room when that person gets something because they're so dramatic. And imagine being their broker. And you're like, oh my gosh, this offer came in $20,000 lower than asking. I do not want to tell them. I had that situation about one where it was a family friend, the father of a family friend. So imagine the generation. I'm 51 next week. So this is some dude who right now is in his 60s or 70s. And you know that generation. My parents' generation, right? And they're like, especially if it's country, good old boys. And I can say so as one. A reformed good old boy. I'm still one at heart. And that guy and his wife would just as soon cuss you out as say hello. But they didn't hate me. I was just the bearer of the bad news. And when I had to give them the news that their house was worth half of what they thought it was, I knew what was coming. My poor wife wasn't prepared. She was there in the room with me because we drove together over there. And first of all, there was a cloud of smoke because they're chronic just chain smokers, and I was prepared for that too. And they're like, what? Blah, 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 and all of the things. And my ears are bleeding. And she's like, in the car on the way home, she said, don't bring me back. If you have to do that again, I don't want to be in the room. But we had to present it. And even if it's a low ball. And that's what I think might keep sellers or agents from doing it properly. They're just scared of the confrontation, perhaps. So they might be inclined to say to that other agent bringing them the offer, oh my gosh, what? This is an embarrassing offer. I'm not even going to present it to my client. It's an insult. And in those cases, you have to be the bigger broker. And you have to say very calmly, because guess what? Our job is to buffer out the emotion. But there's so many brokers I've been up against where I'm like, I have a feeling you're making this worse. When you're talking to your client, you're ganging up on me and making me look like the bad guy probably. And I don't care about that, but I think you're just making the client key off of your emotional response. Let's be more professional. Let's be more calm and more of a buffer. And it's okay for the client to react that way. It's an emotional decision, and it's their home. Especially in residential, it's very much emotional, and that's fine. But our job as a broker is to help counteract that. After they have their reaction, they might decide, okay, well, it is what it is. The market is responding. It's not this one buyer's fault. All the buyers are saying my house is overpriced. And this one buyer made an offer, so let's not be mad at them. Let's be mad at the other 14 that showed it and didn't make offers. So helping them understand, keep things in perspective is frequently our role as well. And so it's tempting for some brokers who aren't as strong to say to their client or to say on behalf of their client, I'm not even going to dignify this and present this. And you have to remind them, well, you better. You have to present all offers. Now, what could you do if you're worried about that other broker just completely screwing it up and getting their seller all in an uproar? Their seller. You're the buyer agent. If you suspect that agent might completely screw up the presentation of your offer, what you could do, talk to your buyer and say, hey, buyer, why don't you ask me to ask them to let me present this offer myself? Your buyer's probably not going to know this is possible. So you just plant the idea in their head. Say, hey, buyer, I get the feeling this offer presentation might go better if I'm in the room. And we can ask, they don't have to agree, but we could at least try. And I'm going to ask that listing agent to ask the seller if they'll let me come over and be at the house and present your offer myself. Because besides you, I'm the next best person to speak for you. And I'm going to present the offer in the best possible light. And that way, this listing agent can't put a weird spin on it that makes the seller not appreciate it for what it is. And that's a thing. You could do it. A lot of people don't because they don't want to go to the trouble. They don't want to even ask, and they don't want to take the time to go over there and do it. And gosh, if you don't like public speaking, if you're in there having to defend a lowball offer, that's going to take some guts. But you might be the one person who does it and convinces them that it's a worthwhile thing to consider. So that's okay, but we would never deny or turn down an offer on behalf of our client. Unless our client said no to it, you relay that information, but you don't receive the offer as their broker and look at it and say, nope, they're not going to take this. I've had plenty, try it. And every time I have to say, well, I can appreciate that is your opinion, but let's see what they say about it. You're going to have to present it. Let me know what they say. We'll work from there. I have to kind of take their word for it. Unless I guess I could say, can I have it in writing that they rejected it? And there is a form for that too. Sometimes you got to play it by ear. Talk to your BIC to guide you through these difficult times. But an agent can't accept on behalf of their client. They just have to pass along the client's decision. Accept or reject or screen offers. They can't say, well, I got these 10 offers. 7 of them are decent, but 3 of them are ridiculous. So I'm just going to present the 7 that are decent. Not allowed. Can't do that. These are very testable things, by the way, guys. This stuff we're talking about in the next few slides here, they like to throw it in there. If an offeree changes the offer, they've rejected it and created a counter offer, we don't have a contract. We just have a different offer. So I think we've talked about that quite a bit. Here's another form. There's a form we could use that I love this form, and it's called a response to buyer's offer. Let's look at it together and see what this thing accomplishes, because you don't have to use it, but it could really serve a good purpose. There we go. All right, a single page, and here's what it does. It's check the box. There's 3 potential uses of this form, and you're only going to pick one of them. So quite often we might use this in the case of a multiple offer situation. So you're in the position of being the listing agent. Put yourself in that place. In your mind, you're the listing agent. If we use this first checkbox, what are we saying? We're saying, look, guys, you haven't quite come up to what the seller's looking for. By the way, you're the listing agent. You will have talked to your seller about this. You're not just giving them this without consulting your seller. You've talked to your seller, and the seller's saying to you, as their listing agent, seller's saying, no, this isn't quite what I want, but I don't want to just reject it. And we've got 5 offers. And so I don't want to pick one of them because they're all so close. Is there a way that I could tell all 5 of them what I would like and see if they'll try again? And yes, here's how you do it. So what this says is, thank you for your offer to purchase. We are not accepting your offer, and therefore this is an official rejection. But this is not a counter offer here, by the way. Let me put this in the chat for you so you can see it a little better if you're having trouble. This is not a counter offer. That's a big difference. You're basically telling them, if you do rewrite your offer to these terms that I'm about to spell out for you, then I don't have to take it. I can still consider it and pick one of them. So this is really good for multiple offers when none of them are quite good enough. There you go. It's in the chat for you. So this is not a counter, but it is a rejection. And the seller would favorably consider the following changes. And so if the price isn't quite right, you'll put the price in that the seller would like. If the closing cost that they're asking the seller pay for them is a little too much, you could remove it or you could lower it. Just any adjustment your seller wants to make to any of those offers, they would do it. And you're basically saying to them, look, try again according to these criteria, and I might pick you, but I'm not obligated to pick you. So that's what this part says. If the above changes are acceptable to you, please submit another offer. Understand that until an offer has been accepted, we are free to consider at any time any other offers at our sole discretion. So it's a good way to handle a multiple offer situation. Now, what's the downside? Well, you've rejected all 5 offers, and so all 5 of them could walk away. So it's going to depend on how strong you feel about the market and how much you are convinced they're not going to walk away, that they will maybe make those changes and come back to you. And they're either going to do that, they're either going to walk away, or they're going to make the changes you suggested, or they're going to stick with what they originally offered and gamble that none of the other ones are making the changes, and that it's just going to depend. But at least it's a way to not have to counter 5 offers at once, because you can't do that. What's the problem with making 5 counter offers at the same time? As a seller, can you make 5 counter offers at the same time? Yeah. What if all 5 accept your counter offer? Can you replicate your house 5 times? No. As a buyer, you can make 5 offers and just be prepared to lose 4 due diligence monies, right? But as a seller, that ain't gonna work. You can't have 5 houses that are exactly the same in the same dirt. Not even possible if you had the money. So that's what we do. One of the ways we could handle this. What else can this form accomplish? If you don't want to use it for this first box, you could use it for this second. You could just say, thank you for your offer. We're going to consider all offers received by this date and time. And so here is your official notice. All offers to be presented by tomorrow at 5 p.m. If you choose to submit another offer, we encourage you to submit that no event later than the date and time above. If you neither submit another offer or withdraw your current one, we will consider the one that you've made so far. But again, it's our discretion. We could pick any other one. We don't obligate ourselves to yours in any way. So this is a way to have from the seller nailed down what sort of a deadline you might want to give everyone. If you've spent any time online looking at houses, you might have seen this mentioned in remarks. For listings, it might say something like highest and best offers due by Sunday at noon or whatever date. We don't use the word highest as much anymore because it is not the case that the highest offer is the best offer. So it's enough just to say best offer. So all best offers you got, the best you can do by such and such date and time. Now, does that mean that if an offer comes in after noon, like at 12:30 on Sunday, and the deadline given was 12, does that mean that we as the listing broker do not present it to the seller? If it's received after the deadline, we still present it. Remember, we present all offers, even offers that are after a seller given deadline. That deadline is almost pointless because, the seller could personally decide not to entertain offers they get after the deadline, but for us brokers, we still have to present them. It would not be in our role to say, well, I'm not going to present it because it's after the deadline. You'd still present all of them. If the seller wants to say, well, this one came in after the deadline, so I'm not even going to entertain it, that's on them, but not on you as a broker. You must present all offers. What if the seller takes one of the offers and now you're under contract by Sunday at 6 p.m. and then Sunday at 9 p.m. you get 3 more offers, even though you're under contract? Do you have to present those offers to your seller? There you go. All offers. Because why? Seller might want to suggest that one of those becomes a backup contract. They might say, well, gosh, I kind of wish they had come in earlier before I took that other one. Let me hang on to this buyer if they're willing to. Would you reach out to their agent? See if they'd be willing to turn this into a backup contract, just in case this first one that now I kind of regret accepting falls apart. And that could work out. So present all offers. You're just an extension of that seller's eyes and ears, right? And you would want to know, if you were the seller and you had a broker, you would want them to tell you everything, right? Finally, the third choice, and again, it's one of the 3 of these. You don't pick more than one of these things for this form. The last one is just a straight up rejection. It's a way for you to get official written notice from your seller that they're going to reject an offer. And again, you don't have to use this form at all, but it's a way for you to say, you know what, this seller, I just want to be really careful about every bit of documentation for this particular seller. Therefore, let's get it in writing that they're rejecting this one. And so that seller can check and say, we reject your offer, and it gives you a thing to send them. And that other agent might ask for it. They might say, well, I know you have multiple offers. Could we get in writing proof that the seller rejected our offer? I haven't seen that very much, but occasionally you might get a buyer who's particularly burned from a past injustice, and they might ask for such a thing. So it's just a way to get that. It's a great form to use, especially that first choice, to give them a list, like a menu of what that seller would favorably consider. And I've had great success with it. I've done this in one case, 3 competing offers, and we gave them one of these like 3 or 4 times. All 3 of them kept coming in so close to each other that my seller could not figure out which one to pick. And it was tough because I just knew the other agents were kind of thinking I might be scamming them and lying to them that there's multiples and that we still need try again. And every time we risked all 3 of them backing out. And at one point, I think one of them stopped making any changes. They just stuck with what they had. But the other 2 kept going. And we finally got to one that was a clear favorite. So sometimes you have to do that. And that's our role, to give the bad news to the losers as well as the good news to the winner. So that response to buyer's offer form that we were just looking at, it's a rejection and it's not a counteroffer. Just a way for your seller to tell them, look, try again, and here's how you can increase your chances trying again with these parameters. What about shopping offers? What do you have to do to beat other offers? What if you get out in the world, you get in the business, and you're a buyer agent? No, you're a listing agent. You're a listing agent, and your listing is so popular that you're getting multiple offers. And one of those offers is from an agent that was in this class. And they say to you, hey, remember me? We were in that class with that weird guy, teacher guy. We go way back. Why don't you pick our offer so we can work together? And oh, by the way, what will it take for your seller to pick my buyer's offer? What do we need to come in with? How strong do we need to be for your seller to pick ours? Because I'd love to work with you. So here's the question. If you were presented with that question, can you answer it? Here's another way for me to ask you that question. Whose permission would you need in order to answer it? What if it is an okay question to ask? It's not illegal. Whose permission would you need to have in order to tell them the answer to the question, how much is the highest offer that's on the table right now? We have 5 offers, and they want to know, what's the one to beat? What's the highest one to beat? Now, let me tell you this. It is not the seller's permission. If it's not the seller's permission that you need, whose permission might it be? There we go. Now we're getting it. Who officially, I guess you could say, is the owner of that information? Right? Who's the one that could give their authority? The one who made the highest offer, right? So the person whose permission you would need in order to disclose the highest offer on the table is the one who made that highest offer. Now you're thinking, what kind of an idiot would ever give you permission to disclose what it would take to beat them? And you're right. Hopefully no one. So the point is, you're probably never going to get that kind of permission. You're never going to have the permission to disclose the highest offer because nobody's that dumb to do something to work against themselves. Say, sure, go ahead and tell everybody my highest offer because they're just going to know what to beat. So that's not even going to happen. But the point is, it's a testable concept they like to throw at you. And everybody says it's the seller's permission that you would need for that, and it's not true. Whose permission does an agent need in order to disclose the highest offer on the table? The one who made the highest offer, that offeror. But you're never going to get it because nobody's that foolish. Okay, now what about this next thing? What if they call you, one of those buyer brokers calls you and says, remember we were in that class together, this house just seems amazing, and I'm sure in a market like this there's multiple offers. Would you let me know? Are there definitely multiple offers on this property? Now here's the question. Whose permission do you need to have to disclose that there are indeed multiple offers? You're the listing agent. Whose business is it to tell you yes or no you may disclose it? And that answer is indeed the seller. That is for the seller to give their permission. Or they may not, but it's up to them. Here's what I do on a listing appointment. I say, hey, seller, we might get multiple offers. What I want to suggest to you now is that you do not give me permission to disclose that we have multiple offers. I don't want to tell people. I want you to tell me not to tell people. Why would it be a good idea maybe for you as the listing agent to not disclose the fact that there are definitely multiple offers on a property? How might that be the best choice for your seller? Because when you think about it, at first you're like, Well, of course, you want to always give people incentive to make a competing offer, but you got it. In this kind of market, we have all kinds of buyers that are burned out because they've tried many times and have lost and lost and lost. And this is like the seventh one that they're trying. And they might be exhausted. And they might have said to their buyer agent, would you call them ahead of time? I don't have the energy or the ambition to make another offer that I'm just going to lose. Would you see if there's multiple offers? Because if there are, I'm not even going to make an offer. Now, their agent would probably need to explain to them, well, I can appreciate that you're emotionally distraught. I get it. However, if you think we're going to find a house that doesn't have multiple offers, then that's probably not going to be possible. But that's on them. You just want to make sure that you do whatever you can to get as many offers for your seller to entertain as you possibly can. And you don't want to risk scaring anybody away. And that's what this strategy is all about. So what I like to do, they call me and they say, are there multiple offers? I'll just very politely say, I'm sorry, the seller has not given me permission to disclose the number of offers. By the way, guys, what's a number? 1 is a number. 0 is a number. 2, 3, 4, 5, 10 is a number. So basically, I'm just going to have that stock answer. As long as my seller understands and gives me permission, I feel like it's probably the best choice. Long as they agree, that's what I'm going to say. Even if there's no offers on the table. Even if there's only one offer on the table, it's none of their business. Another way to say this is this first line. Multiple offers are not a material fact. If there's multiple offers on a property, that is not material. Therefore, we do not have to disclose it. But the thing is, you got to be fair to everybody. You can't just tell the first offeror that there are multiples, but not the other 3. You got to say the same answer to everyone. Either you're not telling everyone or you are telling everyone. So you got to be fair to everyone. Those are easy points, but they're easy to confuse. So again, the fact that there's multiple offers is for the seller to give their permission. The highest offer on the table is something you'll never get permission to disclose because that would have to come from the one who made the highest offer. All right. We talked about the offers must be presented immediately but not later than 3 days. Well, this is a little different. This is any documents that your client signs must be provided to them immediately, but not later than 3 days. So again, anything they ever sign, working with agent's brochure, disclosure, buyer agency agreement, listing agreement, offer, turning it into a contract, amendments and addenda, any paperwork, anything they sign electronically or wet or otherwise, you need to give them. And you also need to give to your BIC, by the way, immediately, but not later than 3 days. And you need to keep it yourself for 3 years. Anything they sign goes into the file, and all those files you keep for every transaction for 3 years. By the way, what if you talk to a buyer about the working with agents disclosure, get them to sign it, and you never hear from them again? You don't have a closing with them. They just ghost you. But you did talk to them about real estate to the point of money and motivation, to the point where you needed to get a working with agents disclosure, and you do have it. How long do you have to keep that? Working with agents disclosure. There you go. 3 years also, even though it's not a closed transaction. Doesn't matter. So I say all that to say this. Guess what? The real estate commission could come to your office randomly, unannounced, and say, we need to take a look around. We're going to look through some files spontaneously, an auditor. And what if they pull your files? And in your files, are they going to want to see the exact number of working with agents disclosures as there are closed transactions? Or is that going to be lopsided? It's going to need to be lopsided. Because are they going to believe that you closed every single person that you ever talked about money and motivation with? Probably not. They're going to say, this looks a little manufactured to us. We feel like you should have more working with agents disclosures signed than you do finalized sale files, transactions that are actually closed. So just a little warning there, a little heads up. Get it all, keep it all for 3 years, maybe even longer. I mean, heck, what's the space it takes electronically? You can keep it physically, you can keep it electronically. It might be that some kind of litigation pops up 5 years down the road or 10 years down the road. Might be in your best interest to keep those files longer, but the Real Estate Commission says 3 years minimum. Sometimes if we go old school, we might have lots and lots of changes on one document, on one contract, and it looks messy. And we have all this mess. We have all these mark-throughs and initials and just all kinds of stuff like this. And it becomes hard to figure out what was intended, especially the place where the warranty is mentioned. I've had that pop up where in one version of the contract or the offer, counter offer back and forth, it said the seller was going to pay for a warranty. And in another one, they crossed it out because the seller didn't want to pay for the warranty if it's going to be a lower price. And so looking back later, it's like, wait, where did we land on this? Is the seller buying a warranty or not? And so the way we can protect against that sort of confusion, the commission says, is make it neat. Rewrite it fresh. Once you go back and forth a million times with all those counteroffers, make it a nice, new, fresh, clean one with no strike-throughs, no changes. Let's keep it very clear and understandable and transparent. So rewrite that contract, make it fresh and clean. Don't have all these random initials and strike-throughs everywhere. Make sure everybody gets it. If offerors and offerees want to add a condition to a contract, not an offer, but a contract, and really I probably should change the offeror, offeree words to seller and buyer. So if a seller and a buyer want to add a condition to a contract, they would use what sort of form? You're getting it. It's not an addendum, it's an amendment. That's an amendment to the Constitution. It's a change order. We're changing a contract. That's an amendment. Well done. True or false? Multiple offers should be delivered in the order they are received so the offeree can consider each one in the proper order. What do you think? We haven't really talked about this yet, but what do you think? Should it matter? First come, first serve, dibs, none of that matters. The Real Estate Commission says they shouldn't give any priority to when an offer comes in. For a broker, you're going to get offers. You're not sitting by the phone or your email. You're not seeing every single time an offer comes in and having to make a note and say, this one came in 13th, this was the 14th. No. You're going to be going to the movies with your family. You're going to be going showing property with another client. And you're going to come back when you can focus and you're going to check your phone and you're going to have 4 offers on that property. And then another couple hours later, after you have some other appointments, you're going to have 3 more offers on that property. You're just going to forward them as you get them, right? Without regard of taking the time to say, well, this one came in 13th and this was 14th. No priority is to be given on the order in which they arrive. Yeah, it probably is to some degree, good point, Catherine, going to be a natural thing. But the point is, you're not just going to intentionally say, well, this was first, so let's give them more preference, more priority. That's what the Real Estate Commission is trying to accomplish there, so that the seller doesn't give priority because of someone who makes an offer before another. As a broker, the responsibility is on us to batch deliver. You know, as we get them, we send them. We don't necessarily keep them and stockpile them and just release them all at once because we got to deliver them immediately, but not later than 3 days. But on the test question, the answer to such a question would be deliver without regard for when they arrived. You don't need to tell them this account. But obviously, if it's emailed, forward emails, they're going to see the time, but you don't have to make a point of it. When we come back from break, we'll talk about these weird things. They're a little bit different, and we'll get into that when I see you in 10 minutes. right, let's come on back to the last little bit. Welcome back. We've got a couple of weird little things that I've actually probably never dealt with hardly at all to talk about. These three things, an installment land contract, as well as preemptive rights. We've talked about options before. Preemptive rights are sort of like an option to purchase, but different. And one key difference we'll talk about in just a moment. But let's talk about the installment land contract. When you see that phrase, installment land contract, it's just seller financing. The seller's doing the financing, right? So the buyer is buying the property from the seller, and the seller is going to be the lender. So instead of the buyer paying the seller $300,000 for the purchase price, they're going to acknowledge that the purchase price is $300,000. But then they're going to make payments every month, not give them the big chunk. Those payments are going to be based on an interest rate. However much they might put a down payment or give them some sort of a deposit, but for the most part, they're making their payments to the seller instead of giving them all the money. Why would a seller do seller financing? Tell me in the chat. Why would you as a seller consider selling in this way instead of just getting all the money up front? What's the upside to doing seller financing? Well, there you go. You're making more than $300,000, right? What's that look like? Well, we'll get more into this when we do finance next, but if the loan amount that you're borrowing from that seller is $300,000 and you're doing it at 6% interest rate, that's $18,000 a year of interest that the seller's making. So they're getting their $300,000 eventually, but along the way, every year, they're getting $18,000. Essentially $1,500 a month of interest. I'll take it. What if you had 10 people with the same deal? You okay with $15,000 a month just because you woke up, went to the mailbox, and picked up the check? Yeah, let's do that. Let's be the bank, right? Let's be the bank if we could be the bank. But there is a downside. You might need all of that money. What good is $1,500 a month if what you need is $300,000 to buy the next house you want to move to? And that's what most people do. And most people want or prefer. Ideally, financially, you could say that everybody should always keep every house they buy and never sell it. Because by the time you reach like 40 or 50, you probably would own 4 or 5 houses. And many of them would be pretty darn close to being paid off. And then you could have a situation like this per month. But it's just not realistic, right? It's not what most people are willing to do. They want to get all the money out of it for that sale and apply it because they're buying the next one and the next bigger one and the next bigger one. Not saying that's the right decision. It's just the way things seem to work. But what are the other ins and outs of this seller financing concept? If it's seller financing, the seller keeps the legal title. They keep the deed. What the buyer is getting is sort of like what a renter is getting. Possession, equitable title. They get to use it. Yeah, they are the owner, but they don't have the deed in hand until the entire debt is paid off. At that point, they'll get both the deed and the legal title, which is the legal title, which is the deed, will get transferred to them when they pay the entire thing in full. Now, in order for an installment land contract to be protected against third-party claims of ownership, it needs to be recorded. It's another Connor Act document. So it should be recorded. And then the names of the parties are important to distinguish here too. This is also something different about this. The names of the parties don't exactly make sense. There's no real easy way to memorize it because the name of the seller, when it's installment land contract, seller financing, is a vendor. The name of the buyer is a vendee. So vendor, vendee. You see those words, you know it's an installment land contract. This is not a deep dive, guys. This particular topic is not some level 3 stuff. It's probably, if I had to look it up real quick, probably be like a level 1. Just basically knowing the ins and outs of it here. So what is it? Why would a buyer agree to seller financing instead of just going to Bank of America or Wells Fargo, getting a traditional mortgage? What kind of buyer are we dealing with who's looking for a seller financing situation? Yeah, probably not an ideal one. Probably not a buyer with a lot of options to get traditional financing. And also, what kind of seller? Besides wanting to maybe get the interest, it might be a seller who's having trouble selling it. They've tried to sell it to traditional buyers, but there's something kind of weird about it. Maybe it's a weird shape. Maybe it's old and needs a lot of work and buyers just aren't willing to put up with it and the seller's not willing or able to fix it. So it could be like a buyer and a seller who aren't the ideal ones. The thing about an installment land contract is it's hard on the buyer in particular if they get foreclosed, because any payments they've made they're going to lose. The property itself, they're going to lose. And any profits on the sale, they're not going to get either. So it's not great. Again, it's going to be a buyer who doesn't have very many options that would probably settle for this installment land contract arrangement. It has a place, but it is tougher on the buyer when it's a foreclosure situation. They don't have a chance to make it up and catch up and keep the property. That's it for installment land contract. Let's recap option to purchase again. We've talked about it before, and it's essentially it's a unilateral contract for one thing, because the seller has to just sit back and wait for the buyer to decide if they want to exercise their option to buy it or not. So it's unilateral. The optionee, the one with the option, the one deciding whether to buy it or not, pays a fee for the privilege. For the privilege of having that amount of time, maybe a year, to decide if they want to buy it. Maybe they're waiting for a zoning vote to see if the zoning can get changed, because then it will be worth more for their particular use that they intend. And they pay a fee for this option period, and that seller gets that fee, and they say, well, okay, you gave me the option fee, so I'll give you this amount of time, and I won't sell it out from under you. I can't. Here's the thing about an option to purchase compared to the next things we're going to look at. With an option to purchase, this is not something a renter would use on the house that they're renting that they might want to buy. You ever seen of or been a renter and you're like, you know what? I wouldn't mind owning this place. If that's the situation, it would not be this that we use. So if someone using an option to purchase has to stay away, they don't get to use the property. They don't get to possess it. So it would not be a renter using an option to purchase. A renter would use one of these other preemptive rights we're going to study next. So this is an easy test question. An option to purchase is not for someone who's renting the property. It's not for someone who's using it. You have to stay away, stay off the property. And then they have that amount of time to decide to buy it or not. In order for it to be enforceable, it also needs to be recorded. We've seen that already before. And the seller does not have a choice about shortening that time frame. They just have to sit back and wait, see what that buyer wants to do. Seller cannot terminate the option period. They took the money, they got to give it the time that they agreed to give. So an option to purchase, is this for a renter who wants to have a chance at buying the thing they're renting? Head nod or head shake in the chat. No, it is not for a renter. So this would not be a rent to own type of situation. What could be for a renter, though? One of these. These are two things that could be used by a renter situation. And let's take the first one. Let's take that top one. The right of first refusal. Both of these things are what are called preemptive rights. Preemptive, to do something ahead of time, to make arrangements ahead of time, essentially. So a right of first refusal says, look, seller, if you get an offer from a third party, you won't sell it to them without coming to me first. I want to have the first position. I want to have the right to meet or beat that offer you might get from somebody in the future. You won't sell it to them until you check with me first. That's what a right of first refusal is. And so because we don't yet know what that future offer might be, we don't negotiate the price up front. We're going to handle that later. That's one of the differences between these two types of preemptive rights. When do you negotiate? One of them you negotiate later. The other one you negotiate up front. So right of first refusal is just for the situation where the seller might get an offer down the road and they give this current person the automatic chance to meet or beat that future offer that might come in. That's what it is. First refusal, right of first refusal. The right of first opportunity to purchase, the second one I hear, says, look, the seller might not want to sell it today, but they might decide to sell it later. And if they do decide to sell it down the road, again, you'll give me the chance to buy it before you sell it to anyone else. Rather than try to sell it to somebody else, you know that I am interested. So run it by me first. And you'd have this thing in writing. You would have this right of first opportunity to purchase in writing, signed by both, so that you have it nailed down that you are to be given that opportunity. And therefore, since we're doing it this way instead of first refusal, we figure out that price up front. If you decide to sell later, you'll sell it to me for this amount of money. Price is set at the time the right is established. So again, this right of first opportunity is for the seller who might decide to sell later. The right of first refusal is for a seller who gets an offer later, giving the holder of the right the chance to meet or beat that offer. These are easy to mix up, so just be careful and I'd make a chart, and then I'd try to come back tomorrow and make that chart from memory, and you'll screw it up, but that's what makes you get it. When you screw it up, then go back and look again and say, oh no, that was wrong. I had this over there and that over there. So use the chart process to get this type of thing too. But these are also, but not necessarily, what a renter would use to buy the property they're renting. Doesn't have to be, but if it is a renter who wants to rent to own, then yes, it would be one of these. It would not be an option to purchase. It would be a preemptive right, either first refusal or first opportunity to purchase. Yes, it would need to be recorded in order to be enforced, or in writing to be enforceable, and recorded to protect against third-party claims, just like other things. So for an option to purchase, true or false, the tenant has the right to decide whether they want to purchase the property at a future date. Is that true or false when it's an option to purchase? Sometimes the question is worded in a way that's a little deceitful. For an option to purchase, does the tenant have the right to decide whether they want to purchase the property at a future date? Let's recap again. These preemptive rights could be a tenant, could be a renter. But an option to purchase is not a renter because they stay off the property. They don't get to possess it. So with that in mind, For an option to purchase, does a tenant have the right to decide whether they want to purchase at a future date? No. A tenant can't use an option to purchase to buy the property they're in. They would have to use one of these other types. If they want to decide to buy it later, they would either have to hope the seller decides to sell it later, or that the seller gets an offer from a third party later. Because it's with one of these preemptive rights that the person could be living there in the meantime. With an option to purchase, they don't stay there. They don't get to use it in the meantime. So this is false. There is no tenant situation. It'd be one of these things, not an option to purchase. Let's look at a couple of notes, little reminders, and then we're done with chapter 10. All offers must be given to the seller immediately, but not later than 3 days. Whose permission would you have to disclose the fact that there are multiple offers? Multiple offers, it's up to the seller to allow you to disclose that. You got it. And you got to submit those offers immediately. You can't stockpile them. You got to deliver immediately, not later than 3 days. And you shouldn't do any sort of screening and weeding out or accepting on their behalf or rejecting on their behalf. Multiple offers is not a material fact. And if you make a lot of changes during the back and forth counter offers and make the contract or the offer all messy, you need to type it up fresh. Get it nice and fresh and neat and very understandable, very legible and clear. Don't have a bunch of cross-throughs and initials everywhere. Make it nice and clean and tidy as if it were perfect right out of the gates. To avoid confusion. All right. That is chapter 10. We'll do some more review of it in the future. But let's touch on financing before we finish tonight. This is syllabus section 11. Hang on a second. And in your book, it's 14 and 15 comprise the finance stuff. So we'll start with 14, obviously, but again, syllabus section 11. We're going to look at the factors that led to the financial crisis and how does the Federal Reserve factor into this whole thing. We're going to learn about what the primary mortgage market is, what the secondary mortgage market is, a couple of specific loan types we've already kind of touched on, conventional, FHA, and VA, and some special ones. What are the practices and procedures involved in lending? And what are some finance legislation items and the purposes of those as well? So our level 1 are the markets, the policy, the USDA loan, special kinds of mortgages, and something called the Equal Credit Opportunity Act. Just knowing definitions falls under level 1 recall. And there's some level 2, getting more of a deep dive into the specific kind of loans called a conventional loan, FHA or VA loan, and the priority of mortgage liens and practices of lending. There are 12 national questions coming from this chapter, so it's another high ticket item. So let's start here. We're talking about borrowing money, right? And most purchases involve borrowing money. There are still plenty of cash buyers out there, but most of them are going to be financed. And so anytime you're borrowing money, you've got the lender of the money. Why are they interested in loaning money? Because they want to make that long-term, over the coming months and years, interest income. You're paying them for the privilege of borrowing that chunk. The chunk you're borrowing is the principal, also called the principal loan amount. And so it kind of looks like this. You've got the loan amount. Let's say it's $100,000 you're borrowing. That's the top amount you're borrowing. The lender might require that they might not let you borrow that entire amount. They might say, I want you to put some down payment. I want you to have some skin in the game. I want you to have something to lose, something to motivate you to keep making your mortgage payment. So they might say, if you want to borrow $100,000, you've got to put down a certain percentage of down payment. And so that's your part. That's your portion. And so on day one of this new loan that you just closed on, your down payment, let's say, is $10,000. Let's adjust some things here. And let's say the purchase price is $100, and so the loan amount is this way. Loan amount is $90,000, and your down payment is $10,000 to add up to the sale price of the $100. So our sales price is $100,000. You're going to borrow 90% of that. That's called a 90% loan to value ratio, because the percentage of your loan compared to the value is 90. You're borrowing 90% of that sale price or that market value. So this is a 90% LTV. This is 90% of it, and that's what you're borrowing. That is your principal loan amount, not principal to the transaction. We're using words in a couple different ways. So your principal loan amount is this big chunk you're borrowing. And so on day one, when you first close the property and bring this $10,000 down payment, how much equity do you have in this property on day one? What is your equity? Is it the 90 or is it the 10? The equity you have in the property is your piece. And so your equity in this moment is $10,000. That's what you stand to lose. And then what's going to happen over time? As you own the property longer, your equity is going to increase, because one thing that's going to happen is this loan amount is going to decrease. You owed $90,000 on day one, but after 5 years, you've paid your mortgage and you've knocked down this to maybe, let's say, $85,000. Now, if you were to sell your property, you're going to have to pay back the lender the remaining amount you owe, which is no longer 90, but just 85. So one way that you can increase your equity position in this property is paying down your mortgage, lowering your loan amount by just making your natural monthly payments. And then if you're like Jim at the coffee shop I go to, Jim retired early back when COVID happened. Jim has been very gradually and carefully making very educated and safe stock market purchases for many years. He'll talk to you for 3 hours about that. And one thing Jim does every month is pay this month's mortgage payment, and he'll go ahead and find out what the principal part of the payment is next month, and he'll pay that too. He's making basically double payments on his mortgage because he can. And so what's happening for good old buddy Jim is his 30-year mortgage is getting chopped in half to a 15-year mortgage because he's paying double every month. He's cheating that lender out of a lot of interest. It's not really cheating, but the lender's not thrilled about it. They were counting on 30 years of house payments at interest amounts every month, and Jim is shorting them by half. Not many people can do that. Not many people are living so far within their means that they can make double house payments. So by doing that, he's eliminating half of the interest, essentially. So we're gonna use a lot of terms, throw them around quite a bit. And so this loan amount, principal loan amount, that is one way, again, to increase your equity. When you sell that property in 5 years, you bought it for $100, but 5 years later, maybe you could sell it for $120. Why? because it appreciated in value. Ask anybody that sold a house in the last 3 or 4 years. They saw some significant appreciation, right? So that's another way your equity could go up. Your equity in the property could go up because the property appreciated. So it's already gone up because you've paid the loan amount down, and now it's going up because your property appreciated too. And what's one more third way your equity could increase? Well, what did you do these last 5 years? You put granite in the kitchen. It had Formica countertops. You put granite countertops in. You also added a sunroom on the back, like a whole extra room with its own roof and sliding doors with screens and glass, and you could pick which one you wanted. And you also turned the carport into a garage. And you probably painted and you did some other things, but these sorts of capital improvements added value to the house. Now, because of these capital improvements, this 120 that it appreciated up to is worth even more. Now it's more like 130 because you did all this stuff. Heck, let's go better than that. Let's call it 140 because of all these three things. So you've added to your equity position because you've added things to the property, capital improvements, made it better. It naturally appreciated as real estate tends to do over time. And along the way, you made your house payment like a good person, like a good boy and girl, and you paid your loan down a little bit by a little every month. So that means when you go to sell it, compared to when you bought it, okay, your loan amount today, 5 years later, is $85,000. The property is now worth $140 because of appreciation and also because of your capital improvements. And what are you going to walk out with when you sell that property? Oh, $55,000. What did you have as equity in the property when you bought it? $10,000. Your equity position has gone up to $55,000 because of those three things. So knowing the difference between your equity and the loan amount is something we're going to keep coming back around to, especially when we start doing math, because finance has quite a good chunk of math in it that we'll get to next week. So you have time to brace yourself for the math, but I don't want this to be scary. The loan amount of $90,000 every month, you're making a house payment, and let's just say your payment is $1,200 a month. That's going to depend on your loan amount. It's going to depend on the interest rate. But when it's all said and done, let's say that your entire loan payment every month, your mortgage payment is $1,200. Here's what that mortgage payment looks like. It's your monthly payment. It's always going to be $1,200 as long as you have a normal fixed rate, fully amortized mortgage. Fully amortized, what's that mean? It means when you start out borrowing money, this total $90,000 that we talked about, and make payments every month, eventually that loan amount goes to zero, probably 30 years from now if it's a 30-year loan. And so amortize comes from the word mort. Where does that word come from? Mortician, which means death. Essentially the death of your loan. It's dying over time. Your loan is going all the way to nothing. It's going to zero. So amortization means you're set up for your loan to go down to nothing. And that's great. We want that to happen. So every month in a fixed rate, fully amortized loan, you have the same payment every month. But how much of that payment is going to the lender in the form of interest? You've got two things that makes up that payment. One of them is interest. Some of that $1,200 payment is going to go to the lender for the privilege of borrowing the money. So some of it is for interest and the other is for the principal on your loan. Principal. Interest is the profit to the lender. Principal is paying them back what you borrowed from them. So if you were to look at an amortization schedule, you would see that by the time you pay back a 30-year loan, you might have borrowed $100,000, but you ended up paying $300,000 to the lender. You paid him back the 100 plus another $200,000 in the form of interest. And I just pulled those numbers from air, but it is pretty significantly more than your original loan amount. So back to this question. Of your monthly payment of $1,200 every month that does not change, in the beginning, in the first half of your loan term, let's say the first 15 years of a 30-year term, that portion of this $1,200 that's going toward interest is probably like this much. The very first payment, it's very lopsided. Most of that $1,200, maybe $1,150, is going to the lender as their own profit. Interest to the lender is what they're making. It's why they're making you that loan. Another word that you might see it called is lender yield. They're yielding it, they're making it, they're earning it. That's why they're doing it. That's why they're in this business, is to make interest off of the amount that they're loaning to you. Now, the first few months, that interest is really lopsided, like we talked about. Maybe the second month, this much of it is going toward interest. And then the third month, this much. And so somewhere around year 15, it's a pretty even split. Half of that monthly payment of $1,200 is going to the lender in the form of their interest or their profit, and the other half is going to knock your principal down. So in this case, $600 for both for a little while. Somewhere around that 15th year, it starts to flip-flop, and then that last payment you make on month 359, 360, somewhere in there, this much, let me do a different color. This much of your payment is knocking down your principal loan amount. More of your $1,200 payment is serving to knock your principal down than is being interest to the lender. They stack it. The lender stacks it in their favor so that in the first half of the loan, the biggest proportion of your monthly payment is going into their pocket, and a small chunk of it is used to to pay your loan amount down. So that's generally how this whole thing works. So know the difference between principal and interest. Principal is what you've borrowed, and by paying it down, you increase your equity. The equity is what you're going to walk away with when you sell the property. Now, we did math a little bit ago, and I think I showed you your equity was $55,000 5 years later. Well, does that mean you're putting $55,000 in your pocket? Probably not. You're going to have to pay some taxes for the current year you've closed on the house. You might have to pay some deadbeat real estate broker for helping you sell your property. You know, those brokers are so overpaid. They charge you all this ridiculous commission. You're going to have to pay something called excise tax. It's a sales tax that the seller pays. So you're going to have expenses. So you might end up not with $55,000 of your equity. You're going to have to spend some of your equity to just have the transaction. Maybe you'll end up with $45,000 or $40,000 when it's all said and done. And that's part of what we do, is help that seller understand, what are your expenses going to be? Yes, your equity is 55, but you're not getting 55 in hand to go use to the next purchase. You might end up, after you pay me, because I'm worth it, you might end up with 40 or 45. So interest is what you're paying to the lender. It's why they're doing this. Another term for the payment, that $1,200 payment, that monthly mortgage payment, another term that you'll see that called is debt service. You're servicing your debt. You have a debt and you're servicing it by paying it every month. So debt service is your principal and interest payment that you're making every month. Those interest payments do not increase your equity. Again, that's your profit to the lender. That's what the lender's making. They don't serve to lower the amount you owe. That's over and above. Remember in the beginning of Rocky, the movie Rocky, anybody seen that lately? The first thing he's doing is not boxing. He's going after some dude trying to break his thumbs because he didn't pay the guy he borrowed the money from. But he's kind of soft at heart, so he doesn't have the heart, and he lets the guy slide and he gets in trouble. So they're not breaking our thumbs, but they are willing and able and prepared, and they have your permission that you gave them when you agreed to borrow this money, they, the lender, to foreclose on you if you don't pay your mortgage payment. And that could happen after the first month or the second or the 14th. It just depends. It's up to the lender when they want to initiate foreclosure. So that's a thing. You stand to lose it. If you don't pay, you don't stay. Got to pay that house payment. But those interest payments are to the lender. That's their profit. That does not come off your loan amount. There's that amortization word. Mort means death, like death of the mortgage. And there's a prettier version of what I already showed you. Month one of a $1,500 per month payment, the vast majority is going to their profit, to their interest pocket of the lender. A little teensy bit of it is paying your loan down. Compare that to the very last payment of a 30-year term. It's flipped. Most of it's coming off your loan amount. Very little bit's going as profit. Here's what it looks like with an amortization chart. The blue line is the loan balance. You started out borrowing, in this case, $180,000, and then over time, around the halfway mark, the proportion of interest to principal that each payment is going toward is even. And then that last half of your loan term, more of your payment is going toward buying your loan principal loan amount down. Amortization. If it's an interest rate that's fixed, you're going to have the same payment every month. It could also be an adjustable interest rate. In fact, if you use a credit union, typically they will make loans, but they insist on them being an adjustable mortgage rate, which means you get to have a rate this year of something that looks pretty attractive to you, probably lower than market, but then next year it might increase. It's going to adjust based on some sort of a published financial index. You know, the boring part of the newspaper that says things like the stock prices, and they'll talk about a treasury bill or 20-year T-bill. It'll be based on some sort of an index like that. That will dictate what that interest rate adjusts to. And odds are it's going to adjust up and not down. So you want to be ready. If you're paying a $1,500 house payment this year because it's amortized on a 6% rate, then next year it might adjust up to a 6.5% rate. Can you afford it at the higher rate? A lot of people couldn't. Back in 2008, years leading up to it, they did it because that was the only way to get into the house. And they thought, well, surely I'll make more money by the time it adjusts. But then life happened and it didn't work out so great. And now they had a higher payment and they were already leveraged too far. Too much. People bought too much. More than they could really afford. And when it adjusts up, it was more than they were making. And they lost their houses. A lot of that led to the crash too. Adjustable rates are not bad. They just need to be respected and treated right. They have a place. And if you buy within your means, then you can handle those fluctuations. But it might be the only way someone could buy something. They just need to make sure they're not buying at their very absolute most budgetary ability. You could also have an interest-only payment. We'll talk about that next, in just a moment. A fully amortized loan, again, means that your payments, every payment, all 360 of them over those 30 years are going to be the same number. But the proportion of those payments being interest versus principal is going to vary with everyone. You're always going to have a $1,550 payment, but your first payment's going to be largely to interest, and your last payment's going to be largely coming off your principal. And then when at the very end, the end of those 360 months, your balance is zero. You've paid it off. Now you can burn up your mortgage, a mortgage burning party. That's what they used to do. That's full amortization. They've created it so that from payment 1 to payment 360, it ends up in zero. You could also do a partial amortization. What's this going to mean? This means that maybe you're going to do a 20-year loan term instead of a 30. And in 20 years, this thing needs to be completely paid off, but you can't afford the payment based on a 20-year loan. When you do the calculation, let's just say, and I'm pulling from air here, a 20-year loan term, your payment is going to be, let's say, $1,600 a month, but your budget just won't handle that. So the loan itself is going to run for 20 years, year 1 all the way to year 20. And that means 240 payments, right? But you're going to amortize the loan as if it were a 30-year term. And when you plug in the number, amortizing it as if it went for a whole nother 10 years to a total of 30, that gets the payment down to something you can afford. Let's say $1,450. So partial amortization means that all the way from payment 1 to payment 239, your payment will be $1,450. And then that very last payment is going to be more than this in order to make up for whatever else you still owe. It's called a balloon payment. You ever heard of that term, balloon payment? That's what it means. You're stretching it out so that your monthly payment is based on sort of a fictional duration, because that last payment is going to be much bigger, some amount bigger than all those first payments were. And that's what's meant by partial amortization. You're not going to have even payments the whole way. All of them will be even except that very last one. That's going to have to pay off whatever is remaining that you owe. An interest-only payment is exactly that. All you're accomplishing when you make an interest-only payment is paying what the lender wants as profit. Nothing is paying your loan down at all. Why would anybody do that? Well, in those years leading up to the crash, people had overbought. They had bought too high, too much that they could not even afford. The reason for the crash was a bunch of things. Part of it was the banks gave money to people that really couldn't qualify, but they thought, well, what could happen? They're always going to make their house payment. They'll let their car get repossessed before they won't make their house payment. Wrong. How many people have seen really nice cars in front of houses that are probably worth the same number as the car, right? So subprime mortgages were very common, meaning not great credit, and therefore not as good of a safe risk, right? A credit paper, probably like 740 credit score up into the 800s. That's somebody that has routinely paid back their loans habitually to the point where their credit score is nice and strong, and a lender feels confident. Well, if they haven't screwed up yet, they're probably not going to screw up for me, so I'll give them the best possible interest rate because of this high credit score. Then they might have like a B paper kind of a score, and that's going to be 739 and down. If you're getting into the fives, that's not great. Good luck. You might have trouble getting any kind of financing. 530, 520 might be about the lower limit before you just don't have that as an option. But a lot of them got loans. Another one were things like 125% loan to value ratios. What the heck does that mean? Well, our example earlier was a 90% LTV, which meant you were putting a 10% down payment, and your 10% down plus the 90% you're borrowing added up to the full 100% of the sale price. What is 125% LTV? That means they're loaning you more than it costs to buy the house. So you got the keys to the house and another 25% in your pocket. You walked out of closing and you could buy whatever you wanted to. They gave you extra money because they figured, well, real estate appreciates. The property's worth this now. It's going to be worth that in the future, in the not too distant future. So what's the problem? So that was another problem. Too free and loose with money. Lenders loaned too easily. We had other things like stated income loans. And we real estate brokers really like these because here's the problem. When you're making 100% commission, which is what we do, we are in the business of legally minimizing our tax burden, right? Trying to pay as little taxes as you can legally. And so when you're in this sort of an independent contractor, 100% commission business, it's even more sensitive that you're trying to minimize your taxes legally as much as you can. Well, your tax returns end up looking pretty pitiful. You might actually be making this much, but according to your tax returns, it looks like you're making this much because of deductions and other legal means that you can use. You have a right to do that. Well, that works great until you're ready to get a loan to buy a house. Then you're going to show your tax returns to the lender and they're going to be like, wait a minute, you only make this and you want to buy this house? You're going to need to make this in order to buy this house. So at that point, you're going to have to take a hit and do your taxes and give up some of those deductions so that you can afford to show that you're making more income, or you could do the smart thing and that's just buy less house that does fit within your current stated tax return income. But that's just another problem. So to combat that, an agent, broker, anybody who made independent contractor type income had this type of loan available to them, this thing called a stated income loan. So you would sit down in front of the loan officer and they would say, look, in order to buy this $500,000 house, you need to make $80,000 a year. Do you? Yes. Okay, sign here. And you sign and they give you the loan. Stated income. It's about that simple. Not much more was required. Well, guess what? People overstated, right? They overestimated their optimism, and it turned into one of the many reasons that people screwed this whole thing up. And the lenders ultimately were to blame because they allowed this stuff to happen. So, one more thing about this interest only, and then we'll be done. When people got a house payment notification, when they got their mortgage payment in the mail, hey, you need to make your payment. And here's the good news, the lender would say. You can make your fully amortized principal and interest payment of $1,600, or you can, this was called a pick-a-pay program. The lender would say you can make your fully amortized payment. If you make $1,600 a month for all of those 360 payments, your loan amount will end up at zero. You will fully pay this thing off. Every payment of that $1,600, some of it will go toward principal, some of it will go toward interest. But if you're having a rough month, if things are getting a little tight, we'll let you make an interest-only payment. Now, the trick to interest only is, yes, it'll only be, let's say, $1,300 a month, but none of this $1,300 pays down your loan. It is all profit to the lender. Interest only, no principal. And people who got in trouble would do it. And it's okay to do this a couple of times, but if you get in the habit and most every time you make your payment, it's at that lower level, then you could go several years, many payments, and never make any progress on paying your loan down. And people did that, and it was a problem. All of it kind of leading to that financial crisis. So interest only means nothing is coming down off of your loan amount. The borrower still owes that loan amount. We'll talk about what happens when you don't pay your mortgage, that foreclosure process. We'll also compare mortgages to deeds of trust. We'll come back next week. They're the same thing. We just call it differently depending on the state. In North Carolina, we call the mortgage a deed of trust. In South Carolina, we call a mortgage. And it's a two-party system versus a three-party system. Go ahead and read ahead. Syllabus 11, read the whole syllabus, section 11. Then start reading chapter 14 and be ready for 14 and 15 next week. And go ahead and flip to the back of those chapters and dig into the math. Get your hands around the loan amount, interest rate kind of math so that you'll be used to seeing a little bit of that when we start doing it together. And if you have trouble with the math, it's okay. I've got ways to make it make sense. So have a great weekend. Put your name in the chat for me, and I appreciate you.